Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlet Fu.
And I'm Katie Greifeld. We're kicking you off to closing bell here in the U.S. You take a look at equity markets right now. There's not too much action today, especially when you think of the start that we had to the week. The S&P 500 currently off by about 0.2%. Same too if you take a look at big tech, down by about 0.2%. Meanwhile, you're seeing quite a rally in the bond market. The 10-year yield down almost 9 basis points. We broke below 450 and we kept going, currently trading around 444. And you take a look at crude oil, Scarlett, this is one of the most important stories out there right now. NYMEX crude currently trading with a 72 handle, off by about 5.5% on the day.
Yeah, consistent with that disinflation theme that has really percolated across the markets right now. Let's hone in on some corporate news because Starbucks baristas walk off the job across 200 U.S. cities. They say the coffee chain is refusing to negotiate fairly with their union, especially when it comes to staffing up on busy days when they launch promotions like free reusable cups today. We're going to speak with a national leader of the Starbucks union. Meantime, the FTC's Lina Khan has a warning for private equity. The Federal Trade Commission chair says get ready for more scrutiny after the agency targeted a buyout firm's roll-up of anesthesiology businesses in Texas. And she may look beyond healthcare to other industries to stamp out anti-competitive behavior. And a top Treasury official says the U.S. government debt market is functioning well despite increased volatility and the regional banking crisis back in March. And Katie, you were talking about Treasuries. I suppose that's playing out today with the 10-year-old falling below 4.5% once again. What are you looking at?
Well, to say the least, it's been a volatile couple of weeks for the Treasury market. So I thought maybe we would just look at the past 6 days when it comes to the 10-year Treasury yield. As you can see, we were crawling higher and higher. Of course, we got back up to 470. And then we got the inflation figures for October, obviously much cooler across the board than economists had been expecting. You saw that plunge like a stone. Yesterday, we gave back some of that. You know, the yield started to come back up again. And then today, here we are, well below 450, and we'll see how low we can go. But you take a look at what Fed expectations look like right now. Of course, after we got that CPI print for last month, we saw rate hikes come out of the equation. When it comes to rate cuts, though, on the other end, for next year, you've seen obviously more pricing come in. Currently, about 90 basis points of cuts are priced into the 2024 outlook, Scarlett, even though we've heard from Fed officials in the days since pushing back on that.
It'll continue to be one of those things we monitor as more data rolls in. So let's kick things off right now with Megan Horneman. She is Chief Investment Officer over at Verdence Capital Advisors. Megan, good to speak with you. We got a bunch of data, and Katie mentioned PPI and CPI, of course, but today we had import prices, export prices that really continue to support that disinflation theme. People in the market are characterizing this as Fed-friendly data. How do you see it?
Well, the inflation data we've seen is definitely going in the right direction. So it does give the Fed the ability to pause in December. But there's three main things that we're looking at still have a long way to go. And this is exactly what the Fed's looking at. It's that sticky inflation. So we've gotten all the way down to about 4% on a year-over-year basis. But in order to get down to that 2%, it's going to take a lot of work. And unfortunately, economic pain. The three areas that we're looking at when it comes to sticky inflation are housing. That is improving, but still well above the historical average on an annual growth. You look at services inflation and then wage inflation. These are areas of the market that we still think need to come down quite a bit before the Fed's going to be able to say it's all clear or even insinuate that rate hikes are anywhere on the horizon.
Okay, so as we talk about sticky inflation, what's interesting, of course, is what CEOs are saying in earnings calls. And Walmart CEO Doug McMillon actually talked about the possibility of deflation. He says we may be managing through a period of deflation in the months to come. Do you see that coming?
You could have sporadic month-over-month declines, and you could get that, especially since we've seen the decline in energy prices, pretty big drop even today. You could see sporadic months where you have negative month-over-month inflation, but to be in a deflationary spiral, I think we're way too far from that. The labor market is still way too tight. I don't see that in the horizon.
Okay, so maybe it's too early to talk about that, but let's game plan a little bit. Say you saw bouts of deflation, as you mentioned. Say we saw disinflation. What's the playbook for that sort of backdrop? Of course, we talk about the inflationary portfolio all the time, what you want to own. On the other end of that, what looks good?
So, in a disinflationary environment, first of all, we have to look at what's going on with the Federal Reserve and how if they're going to continue to raise rates or if they're going to stay on hold. We think that the Fed's going to have to stay on hold, even if we start to get a kind of a ramp up in this disinflation, because there is a long way to go to get them in their comfort zone. So when you're looking at rates being higher for longer, you want to be careful. You want to be cautious. There's nothing wrong with holding cash because, again, those rates are going to be higher for longer. So you're not in any rush to get into the equity market. We think that when it comes to equities, growth stocks, these are still way too optimistic about eventual rate cuts and the timing of those rate cuts and even the magnitude of those rate cuts. We think PE valuations are just still stretched in that area. Value is obviously a bit more attractive in this environment when higher rates for longer. And also when you look at from a relative basis, growth is just so much more expensive than value. Now, as you're coming out of this and we start to get closer to the potential for rate cuts, you want to start looking at things like small and mid cap stocks. That's an area we'd like to get into. Very, very cheap, but also there is some underlying risk as the economy does turn over. So you just want to be prepared to be patient and then invest in those areas that take off when we come out of this on the other side. We're right now relatively neutral in fixed income to the benchmark. That's okay right now as well, but you will eventually start to look at maybe even if moving out of some of that fixed income into the equity market. We're not there yet at all.
And Megan, we don't have a ton of time left, but I do want to get your thoughts on what's going on in the energy market, in the commodity market, because you take a look at crude oil right now. Remember, back in September, we got above $94 a barrel briefly. Right now, we're trading below $73 a barrel. What's your takeaway there? What are the ripple effects?
So I think this is some algorithmic trading that we crossed through these kind of key levels under $70. So I think that's part of the reason there you're seeing this short-term volatility, but it's also a reflection of the economy is slowing. And back in September, that vision wasn't necessarily as clear as it is right now. So the economy is slowing, the global economy is slowing. The biggest concern I have around energy right now, obviously it's good for the consumer. They've been strained by higher energy prices, but what will OPEC do in the next month or two? Will they come through and put additional production cuts because there has been this slide in oil prices? That's a concern that I think the oil markets have to be aware of.
All right, Megan, really appreciate your joining us. Megan Horneman is Chief Investment Officer at Verdence Capital Advisors. And we are expecting remarks from President Biden from the APEC summit in San Francisco. We will bring you those comments live when he does begin to speak. There you have a live shot right now of San Francisco. In the meantime, still to come on the close on Bloomberg, Larry Summers, former U.S. Treasury Secretary, shares his view on all the economic data this week.
Plus, Sean Feld cuts jobs after exiting talks with a potential partnership with Izzy Englander's Millennium Management. We'll bring you the latest.
And Formula One preparing to race right through the neon heart of Las Vegas at speeds over 200 miles an hour. We'll be speaking with Greg Maffei, CEO of Liberty Media, the parent company of Formula One. All that and more coming up. This is The Close on Bloomberg.
There has been a little bit of bite that we have seen on the consumer.
Seeing those cracks in the consumer show up more readily.
When we look at retail sales from a real perspective, adjusted for inflation, volumes are still declining.
When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly.
Retailers certainly need higher volumes to kind of get to the numbers that they want.
If we look back at Q3 earnings guidance from a number of companies,
the consumer is tapped.
Their wallet is very much under pressure.
A key trend that came through was the fact that consumers are under increasing pressure.
The American consumer does have the propensity to spend.
Continues to spend.
When consumers have jobs, they will continue to spend.
The labor market is the catalyst for it.
Will this holiday season be a source of upside surprise or downside surprise when it comes to consumer spending?
The real question is are we going to have a slowdown?
It's all about the consumer.
Well, as you just heard, all eyes on retailers as earnings season draws to a close. Walmart shares slumping as it strikes a cautious tone on the consumer outlook, while you have Macy's, on the other hand, climbing after a profit beat. Here to help make sense of it all is John Edwards. He leads our consumer coverage for Bloomberg News. Let's start with Walmart. It's down 8%. That's its worst day since July 2022. What went wrong?
Well, they are seeing, I think the concern was that they're being cautious about the outlook. That the numbers for the past quarter were basically okay, but the street was looking for much better than okay. It's the cautious tone they're striking about their consumers. They're saying that they saw a sharp slowdown in late October. They've seen some rebound in early November, but they attribute that to discounting and holiday promotions. So overall, it's just people feeling like it's not the excitement they wanted to see from Walmart, especially after what was considered a strong report from Target yesterday.
So expectations were pretty high heading into this Walmart report. You look at Walmart stock up about 9.1% since its last earnings report. So it really had to knock it out of the park to impress investors this time.
Yeah, that's exactly right. And interesting, relatively, again, speaking of Target, Target's same-store sales were down in the past quarter. Same at Home Depot, whereas Walmart's same-store sales did rise, just at a slower pace than last year, but they are still gaining, and they're gaining market share. So they are, and some of the analysts have said they're in a relatively strong position going into the holiday season here.
And can we talk about that quote from the CEO that I feel like everyone is talking about? Yeah. He said that, quote, in the U.S., we may be managing through a period of deflation in the months to come. And while that would put more unit pressure on us, we welcome it because it's better for our customers. We've been so obsessed with inflation. To hear this from the CEO was pretty surprising, to say the least. But as he said, that would be good news for the people actually buying Walmart products.
Yeah, he said specifically he's talking about dry grocery and consumables, but yeah, very surprising to hear the D word coming from anyone. As he alluded to, again, Walmart thinks that it's in a pretty sweet spot in terms of its appeal to consumers. So if prices were to start going down either in categories or broadly, they think that would just help them even more as they, firm up their low price offer and bring in, more customers away from the competition.
All right, John Edwards, thank you so much for giving us insight on the world's biggest retailer, Walmart. And of course, we're going to put this into context here because Barclays has just released its latest global outlook for 2024. Basically, it sees the world economy slowing next year, but in a fairly benign fashion with low peak jobless rates and further declines in inflation. Barclays says there won't be an outright soft landing, but it will be distinctly soft-ish. Joining us now to discuss the report and more is Marc Giannoni, Chief U.S. Economist at Barclays. Marc, so good to speak with you. I'm just going to rip up the script for a moment here because we were talking about the prospect of deflation with our John Edwards based on the comments from the Walmart CEO. You're talking about a slowdown in inflation. Where does this idea of deflation come from? I mean, is this something that we might see more of across the board?
Yeah, thanks very much for having me. Well, I think on the deflation is probably a characterization of what we may see on the goods side. And if we think about what the evolution of inflation in the U.S. economy, I mean, we had a very sharp increase in inflation back in 2021 during the pandemic, as we faced really shortages of materials, of semiconductors, and so on. And then this inflation in goods really came down very, very sharply as the supply of goods increased again. But the problem with the inflation really, especially in the U.S. economy, but elsewhere as well, it has to do with services. And that's where we still have the price pressures. One of your previous speaker here talked about housing. Clearly, we still have some inflation on the housing side. Even if that comes down, I think the part that's much more sticky and much more difficult to bring down is the services prices outside of housing. And there we haven't seen nearly as much progress.
Yeah, that's great. Thank you for breaking it down between spending on services versus on products and goods, hard goods. Can you give us a synthesis of all this and what this means in terms of consumer spending patterns, especially as we head into the year end and into next year? What does this mean for people's willingness to really extend themselves when it comes to spending? Because that's been driving the U.S. economy in a way that's surprised almost everyone.
Absolutely. We had a very strong growth in the third quarter of this year when everybody was basically expecting a slowdown, but we had very, very strong growth with GDP growing at about 5%. Much of this was driven by the consumer. So consumption overall grew 4%. So we don't expect, and I don't think anybody expects that consumption is going to continue to grow at that pace. In fact, we expect a meaningful slowdown in the fourth quarter and then into early next year. So more specifically for us, we expect growth to come down to around 1.5% for GDP, to come down to about 1.5% for consumption in the fourth quarter, and then to slow down a little further into the first quarter and second quarter of next year.
And can we talk about some of the data that we got just this week? Because it has been very busy. You think back, we got CPI cooler than expected, retail sales declining but not falling off of a cliff. And then you had initial jobless claims this morning coming in a little bit higher than expected. This has really given a lot of ammunition to really the soft landing people who are out there, the soft landing camp. How are you thinking about all of the data that we've got and what that means for what we could see next year?
Yeah, so the data we've gotten over the past couple of weeks have been on the softer side, and that started with the payroll employment that showed some weaker number than we had been used to. We think the actual release understated the underlying strength in the labor market, in part because of the strike, the UAW strike that reduced the number of jobs in the October month, and we think we'll have a rebound of that in November. But we had softer data as well, as you pointed out, on the retail sales, at least for the headline. Part of that we think is due to autos and to energy prices having come down. So it's in nominal term that it has come down. But we think that the underlying, the so-called control group that really matters for the national, for the overall aggregate consumption, the national income accounts, that was still pretty resilient. And then we had some weaker data on the inflation, the CPI data that you alluded to as well. So we think this is also showed some temporary weakness. We are not convinced that that's going to stay at that level going forward. In fact, we expect some slight rebound going forward.
And Marc, we don't have a lot of time left, but I want to quickly talk about what this means for the Fed. I see that you wrote that the Fed does not cut before the end of 2024. Obviously, you have a lot of people pricing the opposite scenario. How much conviction do you have in that call?
Well, we have a fair amount of conviction, actually a lot of conviction that the Fed is not going to cut rates nearly as much as what the market seems to be expecting. We think the underlying strength of the economy is stronger than what was indicated by the data over the last 10 days or so. We think that the inflation problems for the Fed are not done yet because the services price inflation, as I alluded to, are still very sticky. So the Fed will need to maintain a fairly restrictive stance of policy for a long time. And therefore, we don't think that they're going to cut before the end of next year.
All right, Marc, really appreciate you joining us. That is Marc Giannoni. He is Chief U.S. Economist over at Barclays. And as we mentioned, we are expecting remarks from President Biden from the APEC summit in San Francisco. We'll bring you those comments live once we have them. Until then, much more coming up. This is The Close on Bloomberg.
Breaking barriers, where collaboration and coming together have always been key to unlocking our potential. It's a city that has been shaped by centuries of deep ties to the Asian Pacific region by contributions of people of Asian and Pacific Island heritage. So San Francisco is a natural place to gather and innovate and collaborate for the 2023 APEC Summit, the CEO Summit, and all the events that are taking place this week. And I want to thank everyone who's made this week possible, especially those serving in APEC's Executive Secretariat, APEC Business Advisory Council, the National Center for APEC, and so many others. Today, 21 APEC economies make up more than 60% of the global GDP. We're almost half the global trade. The Asian Pacific is projected to be the largest contributor to global growth over the next 30 years. So, the The vision we pursue for the economic future of our region will rebound far beyond the Asian Pacific. The choices we make are going to matter, it's not hyperbole to suggest, for the entire world. It's up to us to harness the dynamism of our economies and tap the entrepreneurial spirit of our people and unleash the potential, the unlimited potential of our partnerships in order to realize a future that will benefit people not only in the Asian Pacific region, but the whole world. And I mean that sincerely. People everywhere. The future where prosperity is shared and is inclusive, where workers are empowered and their rights are respected. Our economies are sustainable and resilient, and the bridges that connect our people open a golden gate of opportunity to create lives of hope. Just lives of hope. Most people are just hope. You know, it's been my approach here in the United States from the moment my administration took office. We're building an economy from the middle out and the bottom up. Trickle-down economy worked okay sometimes, but not a whole lot trickled down on my dad's kitchen table. But when the middle class does well, the poor have a chance and the wealthy still do very well. Because what happens, the poor have a ladder up, the middle class and the wealthy still do well. Folks, we're already seeing the results. The last quarter, the American economy grew 4.9%, the highest growth rate in 2 years. More people in the United States because many of you sitting there, the CEOs, let's give credit where it's due. More people in the United States are in the workforce today than any time in American history. Our unemployment has been under 4% for 21 straight months. Inflation has come down by 65%, more to do. We now have the lowest inflation rate of any advanced economy in the world. Meanwhile, median household wealth has grown by 37% in real terms since before the pandemic. I acknowledge there's a disconnect between the numbers and how people feel about their place in the world right now. We can deal with the second part as well. We still have work to do, but our model for growing is delivering real results for all Americans. Significant Black unemployment, Latino unemployment, et cetera. The strength of our economy is driving growth and spurring investment throughout our region. And again, because of many of you sitting in front of me made those judgments. And it's drawing investments to the United States, especially from Asia-Pacific economies. Since the start of my administration, companies from across the Asian Pacific have invested over $200 billion in the United States. These are historic investments, creating literally tens of thousands of good-paying jobs. We're 14 million created just since we came to office. All across America in industries that are going to shape the future of this globe. Semiconductors, electric vehicles, batteries, critical materials, hydrogen hubs, and other critical emerging technologies. I've long said it's never been a good bet to bet against the American people. Never. No, I mean it. Think about it. It's never been a good bet. And we're proving it once more. So my message to all of you here today is, leaders of government and industry, you can count on the United States. We're delivering on our promises, and we're doubling down on our progress. And we'll soon be your strong and steady partner as we continue working together to realize the Asian Pacific region that is free and open, prosperous and secure, resilient and connected. By the way, twice since I've been president, I've had the leaders of the Asian Pacific islands come and meet with me in the United States. They're all part of it. I thought when I left the G20 and Vietnam desperately wanted to see me and raise a relationship. It brought me back when I stood in front of that monument to John McCain. All my days growing up, I never thought that would ever occur. Today, I'd like to talk a little about the work we've done in the region to get there and how we're going to go about seeing this road forward. I've said for a long time, the United States is a Pacific power. I had that brief discussion yesterday with President Xi. He asked why he had asked me before, I reminded him, why we were so engaged in the Pacific. It's because we're a Pacific nation. And because of us, there's been peace and security in the region, allowing you to grow. He didn't disagree. By the way, it was a very good, straightforward meeting. We aren't going anywhere. For decades, America's enduring commitment to the region has been a springboard that's enabled growth, transformative growth, ensured the open flow of commerce, lifted millions of people out of poverty. Today, that relationship goes both ways. The United States remains vital to the future of the region, and the region is more vital than ever to the United States of America. It's been my administration's outlook from day one, and we have clearly laid out our approach with our Indo-Pacific strategy. We're delivering across the board, including when it comes to our shared economic agenda. The United States has deep ties with our fellow APEC economies. More than 60% of U.S. exports go to fellow APEC economies. Robust two-way investment between the United States and APEC countries supports good jobs and new opportunities all across the region. And American businesses, significantly represented here in this auditorium, are the largest source of foreign direct investment in the APEC economies. In fact, if we take just the U.S. companies represented here at this summit and look at their new investments in APEC economies in the calendar year, it totaled more than $50 billion so far. Investments announced today from companies like Amazon, United, Delta, Microsoft, to make sure our region is more inclusive and interconnected. Investments announced today from companies like Boeing, Apple, Flexport, Pepsi-Cola, a Pepsi company, I should say, to make our economies greener and more sustainable. Investments today from companies like IBM, Organon, Visa. Look, they make our region more resilient. They all make it more secure. Here in this world-renowned hub of innovation, leading tech companies like Anthropic, and I'm going to mispronounce. I'm not going to even try. It's better not to try and not mispronounce than try and mispronounce. The point is, small and medium-sized businesses and startups are getting into action as well. All the announcements translate into real outcomes that matter to people's lives. They're proof that a strong, dynamic American economy is an engine of growth, economic growth, innovation throughout the entire region. And they're testament to the fact that American investment and American ingenuity are in high demand all across the region. Because when you do business with the United States and our companies, you know what you're getting. High standards, fair practices, protections for workers, world-class ideas and innovation, and a commitment to deal with the environment. Finally, it's a quality guarantee. Look, this is how we've been able to mobilize billions in investment, including major new announcements this morning through our Partnership for Global Infrastructure and Investment. We also work closely to deepen our bilateral economic cooperation with partners throughout the region, especially on the issues that will most impact our future economic success. For example, in September, when I traveled to Vietnam, as I mentioned earlier, to mark a historic new phase in our partnership of our countries, We committed to work together to strengthen the semiconductor supply chain. With India, Japan, Republic of Korea, and Singapore, we've launched new initiatives to shape the technologies and standards that will transform the future. We've deepened economic partnership with the Philippines, Indonesia, Australia, and others. We've renewed and elevated our engagement with critical regional bodies, including the ASEAN and Pacific Islands Forum. And when we offered to host APEC 2 years ago, we committed to modernizing this institution to make it easier for us to work together as we take on the challenges of a new era, and there are many challenges. We're going to see more changes in the next 10 years than we've seen in the last 50 years. That brings me back to the summit and where we go from here. The world is fundamentally different than it was 30 years ago at the first annual APEC leaders meeting at Blake Island in Washington State. The questions we must answer today are not about how much we trade, but about how we build resilience, lift up working people, reduce carbon emissions, and set up our economies to succeed over the long run. How to deliver growth from the bottom up and the middle out so no one gets left behind. And the idea behind this new Indo-Pacific economic framework, a partnership among 14 diverse and dynamic nations, all committed to tackling urgent issues like pandemic response, vulnerable supply chains, climate change, natural disasters, which we've learned can gravely impact our economies. We've announced the framework in May of 2022. And later today, we're launching an important new tool to promote sustainable economic growth and create a race to the top, not the bottom. There are tangible commitments negotiated in record time that are going to deliver meaningful outcomes to make supply chains more resilient, facilitate clean energy transition, and fight corruption. For example, our new supply chain agreement will allow us to better monitor for supply chain challenges before they become the kind of full-scale disruptions we saw during the COVID-19 pandemic, and ensure we're better prepared to shift and adapt when disruptions do occur, and they will. I know you all know better than I, our work is not yet done. This framework will be a platform for ongoing economic cooperation. And we will continue working to better facilitate high-standard trade that advances workers' rights with strong enforcement of labor standards. And at every step, we have upheld our commitment to unions. Each of the framework pillars includes strong pro-labor outcomes that will benefit workers of all economies. It's critical to building a stronger, fairer, more resilient economy for families across the Indo-Pacific. This week, my administration has launched our new global labor strategy to ensure that workers' rights are the centerpiece for economic strategy internationally as well as domestically. That's a primary concern to me. Last week in Illinois, I congratulated the UAW on their record contract with the big three U.S. auto companies. The contracts can lead to thousands of new jobs, billions of dollars in planned investment to keep American auto industry strong and competitive. And I urge any company investing in America to enter into partnerships with the most highly skilled, dedicated, and engaged workers anywhere in the world, American labor. And folks, I asked the Treasury Department to do a study. When labor does well, what does that do to people, all other non-labor folks around the country? Everyone benefits. And by the way, the reason many of you use labor is because they're the best workers in the world. Union. It's not like you show up one day and say, I want to be an electrician. You show up one day and you say, you got 5 years to practice. And then you get a card. I'm also intent on responsibly managing the competition between the United States and the People's Republic of China. That's what we talked a little bit about yesterday, President Xi and I. That's what the world expects of us. And I promise you that's what we're doing. I met with Xi yesterday, leader to leader, to make sure there's no miscommunication between us. As always, I've met with him more than any other world leader because when I was vice president, it was concluded that I should get to know him. It wasn't inappropriate for the President of the United States to be meeting with the Vice President. We've had, prior to this, 68 hours of private meetings, just he and I, each with a simultaneous interpreter. Our discussions have always been candid and constructive. I again emphasize to President Xi that the United States does not seek conflict. And yesterday we announced resumption of military-to-military communication channels to reduce the risk of accidental miscalculation. And it exists. This is not, as my generation would say back in the day, this is not all kumbaya, but it's straightforward. It's straightforward. We have real differences with Beijing when it comes to maintaining fair and level economic playing field and protecting your intellectual property. We're going to continue to address them with smart policies and strong diplomacy. We've also taken targeted action to protect our vital national security interest. Let me be clear. We are de-risking and diversifying our economic relationship with the PRC, not decoupling. Not decoupling. We'll be firm, standing up for our values and our interests. And I was very straightforward, as he was with me yesterday. At the same time, on critical global issues such as climate, AI, counter-narcotics, where it makes sense to work together, we've committed to work together. We're going to continue our commitment to diplomacy, to avoid surprises, and prevent misunderstandings. A stable relationship between the world's two largest economies is not merely good for the two economies, but for the world. A stable relationship. It's good for everyone. Let me close with this. The leader's statement from that first Blake Island summit 30 years ago captured a shared commitment to, quote, deepening the spirit of community, end of quote, among our economies. For all that has changed over the past 3 decades, we have to continue to summon the spirit of community to meet the challenges of today and to seize the enormous possibilities that exist. My staff is tired of hearing me say this for the last, I don't know how many years. The world is at an inflection point where the decisions we make today, this is not hyperbole, are going to shape the direction of the world for decades to come. For decades to come. Just think of AI. That's particularly true in the Asian Pacific, where so much of the future of our world will be written. And I would argue each of us has a part to play in writing that future together. So today, I challenge all of us to measure our successes not based on the bottom line of our balance sheets, but with the lives we lift up through investment, the potential we unleash with our innovation, and the ability to continue to talk with one another. Let's build a global economy where everyone has a chance to succeed and workers have a fair shot, a fair share of the value they create. The United States is stepping up because of many of you in this room. We're not talking the talk, we're backing it up with commitments. You're going to see us follow through. So I want to thank you again for joining us in San Francisco. Thank you for your commitment to APEC and the future of the Asia-Pacific region. And thank you for everything you've already done to make this summit a success. We can do more. God bless you all. Thank you.
That was President Biden speaking at APEC in San Francisco, addressing the U.S.-China summit he held yesterday with Chinese President Xi Jinping, calling it a very good and straightforward meeting. I want to bring in now Bloomberg's Anne-Marie Horneman, who, of course, is one of our chief Washington correspondents, the chief Washington correspondent, but she is in San Francisco right now, traveling with President Biden. And what struck me, Anne-Marie, was when President Biden said that he had met with Xi Jinping more than a decade ago when they were both vice presidents. So there's a bit of shared history history between them that could be leveraged into this kind of super choreographed bilateral meeting with all kinds of multiple top advisors. Did you see that play out in terms of what kind of actual announcements, concrete announcements they're able to make?
Well, Scarlett, President Biden loves to talk about his time as vice president when he says that amongst all the world leaders, he's probably one of the few who spent the most time with Xi Jinping. He usually talks about this story about him and Xi Jinping in the Himalaya mountains and how he told Xi Jinping that when he thinks about America, the word is, quote, possibility, as how he sums up the U.S. And he talked a little bit about that here, about possibility when it comes to the U.S. economy and business. When it comes to what was done, though, and the nitty-gritty of the details of this meeting, all of the deliverables were pretty much agreed upon before these two men met, whether it was Boeing, whether it was fentanyl crackdown in China, the military-to-military communications, which was a key priority for the Biden administration. And the main deliverable and win is that Xi Jinping and President Biden are meeting, and President Biden received a big cloud of applause from these individuals, which are coming out now from this summit. He spoke just behind us when he said that we have reinstated military-to-military communication. Remember, that was really thrown out after Speaker Pelosi went to Taiwan last summer. It was a top priority for the administration, and it does seem like the business community continues to like this idea of lowering the temperature, taking the heat out of the relationship. Xi Jinping last night said he doesn't want to be engaged in a Cold War or a hot war. Today, President Biden is saying that they reinstated military communications. This is something that the business community likes to see. They want to take the temperature down when it comes to geopolitical rhetoric, and potentially this is what Xi Jinping wants to see, because he wants more U.S. investment in China.
Well, Anne-Marie, when it comes to taking the heat out of this relationship, let's talk about a comment that President Joe Biden made last night, of course, in response to a question about whether he still considers Xi Jinping a dictator. President Biden answered he's a dictator in the sense that he's a guy who's running a country, a communist country, that's based on a form of government totally different than ours. Did that dictator comment undo any of the progress made at the summit?
Doesn't undo any of the progress. It obviously irked Beijing. They had to come out with a statement on it. But listen, President Joe Biden has called Xi Jinping a dictator in the past. He said it again last night, and he will continue to say it. We are going into an election year. President Biden has received a lot of criticism from Republicans that he's not tough enough on China when it comes to the economy. This administration, though, did keep those tariffs in place from the Trump administration. They leveled more penalties, export controls on the Chinese economy. But the rhetoric is going to get hotter as we get closer to November of next year. So I imagine President Biden is going to stand by that statement. I spoke to his ambassador to Japan, Rahm Emanuel, who's quite critical, if you look at his Twitter, of China. And he said the same thing. Biden said it, and Biden's going to stand by it. And I imagine the president will say it in the future.
All right, Anne-Marie Horder, as much as President Biden was stressing the improved relations between U.S. and China, not shying away from comments that President Xi Jinping is a dictator, as you mentioned, tilting perhaps towards the campaign next year. All right, Bloomberg's Anne-Marie Horder joining us from San Francisco. Much more ahead on the close. This is Bloomberg.
Time now for top calls. Look at some of the big movers on the back of analyst recommendations. And we start with Catalent. You have Baird lifting its rating to outperform from neutral. And of course, Catalent, which manufactures drug products, it's made the necessary steps to dramatically improve some of its issues, according to the analyst. He also says that the company could see substantial growth opportunities from GLP weight loss drugs. Take a look at the shares right now, though, currently off by about 0.2%. Next up, we have Target downgraded to market perform over at TD Cowen. It's $161 price target cut to $148. You have analyst Oliver Chen expecting to see traffic and unit decline into next year. That's as budget-conscious consumers eat into Target's discretionary offerings. Chen hopes that moderating inflation can free up dollars for consumers to spend. Take a look at shares, also down today by about 0.8%. And finally, we have DoorDash. Deutsche Bank restarting coverage of the delivery service with a buy rating and a price target of $125. The retail delivery market is, quote, massive. And since DoorDash currently only serves about 1% of it, there's, quote, ample opportunity to gain more users and take advantage of changing delivery trends. Shares still down on the day, about 0.5% or so. And those are some of our top calls. Now let's stick with food and beverages here because thousands of Starbucks baristas are on strike today for a one-day work stoppage, claiming the coffee chain is refusing to fairly negotiate with their union. Now today's strike is taking place in more than 200 cities across the countries, and the union says that it's its largest one to date. For more on this, we're joined by Nick Setyan of Wedbush Securities, who has a neutral rating on the shares. And Nick, when you think about the actual number of stores here, it's pretty small relative to Starbucks' footprint. But how do you see this potential strike and potentially more strikes to come impacting Starbucks?
I don't see much of an impact, Katie, frankly. I mean, we've seen it for a couple of years now. It's indirectly impacting Starbucks' decisions in terms of investment in their labor force. It has by far industry-leading comp for its labor, including benefits that are unmatched. And so I am a little surprised that the unionization movement continues to move on, given the fact that Starbucks' compensation is quite frankly unmatched in the restaurants, peer set.
And so, Nick, maybe not too much of a hit from this strike, but let's say that they become more widespread and more frequent. How are you thinking about what that could mean for Starbucks' labor costs overall?
Frankly, I don't think it's going to matter too much. I mean, Starbucks' labor costs continue to increase, self-propelled, self-investment, self-driven investment. Again, I mean, next year, their guidance is inclusive of about a third of the free cash flow savings, going back into investments into labor. So Starbucks has historically always invested in their labor force, in higher wages, in benefits, in training, and they're going to continue to do so. If you think about the trajectory of EPS growth, of EBITDA growth, it should have been much higher. Historically, it should be much higher given their unit growth rates. Given the mid to high single-digit same-store sales growth, it's not higher because of the continuous investments in labor, unionized or not.
Okay, Nick, can you just hold on for 1 second because I do want to come in with some breaking news here on Apple. Apple is pushing to replace the Qualcomm chip, and it is set to slip further behind. Let me just rephrase that. Apple's push to replace its Qualcomm chip in its devices is set to slip a little bit further behind here. The iPhone is losing. Let me just reread this headline here. The push to replace the Qualcomm chip in the iPhone is losing more ground. It's missing a 2025 goal to roll out its own device, its own component inside a device. So we know that Apple has been trying to bring its components in-house as opposed to using Qualcomm and other manufacturers for this, and that effort is not going along as planned right now. So we'll continue to keep you posted on this development. But Nick, let me come back to you here. Apologies for the interruption there with Apple. When we talk about Starbucks, the company has told investors it plans to meet its growth targets by improving efficiency at its cafes. And a lot of that has to do with having its current staff do a lot more, taking care of mobile orders, taking care of the point of sale purchases as well, doing more than perhaps what they thought they were being hired to do. What does that do in terms of its ability to attract talent?
Well, if we go back a couple of years during COVID, the staff did have to do quite a bit more just because of the staffing constraints across the industry. And that was one of the reasons why the unionization, efforts actually got some tailwinds. Over the last 2 years, actually, I'd say over the last year and a half, particularly, Starbucks has made an extra effort to make sure some of those, constraints on labor, some of those pressures on labor overtime, et cetera, having to do too much, are being addressed. So a lot of those efficiency efforts don't necessarily have, to do with, each barista having to do more. It has a lot more to do with automation, et cetera. And so, they're bringing in new coffee machines, for example, that can make a better cup of coffee much faster, and so on. And so that's what a lot of this, efficiency efforts have to do to actually increase throughput, to make, those turnaround times faster, not necessarily to increase the responsibilities of the baristas, but to actually reduce the responsibilities of a given barista.
All right. Well, thank you for explaining that. The other thing that Starbucks is putting a lot of emphasis on is its rewards program, pledging to double its 75 million rewards members in over 5 years, in part by adding more partners to the rewards program in the finance industry and in the hospitality industry. How much upfront investment might that require? Does that cause you to, fine-tune your models right now in any way?
Frankly, I'd give a thumbs up to any incremental investment in their loyalty program. The loyalty customer spends much higher in terms of, the relative to the non-loyalty customer. Their frequency is much higher. So, any incremental spend that drives, incremental loyalty usage is a very, very high return on investment. So, no one on the street's going to frown on incremental investment in labor.
All right, Nick, really appreciate your joining us here. Nick Setyan of Wedbush covers Starbucks, among other companies in his universe. I want to go back to the headline here that we were just breaking for you, and I'm going to do it better this time. Katie Greifeld here with me, of course. Apple falling behind, further behind, in fact, in its effort to make its modem chip for the iPhone, its own modem chip, because it's pretty complex to replace this Qualcomm part. And this is something that Apple's been working on for a while. It wants to bring everything in-house, but it's struggling. Yeah,
this is a multi-billion-dollar effort. You have thousands of employees that have been working on this project since 2018. Apparently, according to this reporting, it's not going super well. You're not seeing too much of a reaction in the Apple shares right now, but you're seeing a little bit more of a move in Qualcomm. It spiked after that headline came out. Small moves overall, but you can see definite impact there. So clearly, traders trying to make sense of this as well. Yeah, and you wonder if it's going to be the chip that Qualcomm makes. What else is next in terms of what Apple's going to produce on its own versus purchasing from contract manufacturers? We'll continue to keep an eye on the stock moves for you. This is The Close on Bloomberg. It's just about 3 p.m. in New York. This is the countdown to the close. Let's get a view from the top. I'm Scarlet Fu. And I'm Katie Greifeld.
And if you look at with the view from the top right now, equities are not doing a whole lot, Katie. They're kind of just, hanging out where they've been over the last couple of weeks, which has been on the up and up.
I think about 24 hours ago, Romaine said that the market was a snooze fest. And you take a look at the market today, it seems like a snooze fest. The S&P 500 unchanged on the day. It was lower. Now it's not. You can see a little bit more action, though, when it comes to small caps, down and then some.
Yeah. And of course, we're looking at yields as well. The 10-year yield below 4.5% again. Is it still the benchmark level that we thought it was maybe 2 weeks ago?
The moves have been so furious in the bond market. It's hard to keep track of the narrative.
Yeah, absolutely. And of course, oil prices. Look at that. WTI down almost 5% on the day, falling below $73 a barrel, lending credence to that disinflation story. And of course, we did get economic data that shows that prices, import prices, export prices are falling. They're pulling back.
Soft landing, nirvana.
Soft landing. All right. Let's put the move in context in equities. So while equities might be a bit of a snooze fest today, keep in mind what's been going on over the last 2.5 weeks. Because for most of November, U.S. stocks have really been on a tear. In the roughly 3 weeks we've had since the S&P has rallied, it's gained in all but 3 days. It's up 9.5% in that period. And this is not the price action, Katie. This is the RSI, the relative strength index for the S&P 500. You could see that we're approaching the overbought level. That's the red horizontal line, which is a complete 180 from the oversold level that we're in late October.
Yeah, and it's pretty amazing that we, looking at that chart, haven't seen overbought since about May. It's been quite a long time. So we'll see what that actually means for the sustainability of this rally. But let's talk about some of the individual movers under the surface. A tale of two retailers. We had the same thing yesterday. Today, it's Macy's and it's Walmart. Let's start with Macy's because it's having a great day, up 4.5%, almost 5% or so. Of course, it reported earnings, improved inventory. It beat when it came to profit. That's what investors are cheering about, even though you saw same-store sales fall for a third quarter, Scarlet. And let's talk about Walmart, because totally different scenario. Shares, I believe they're having the worst day in over a year or so.
Yeah, down 8%. Whoa.
Yeah, ouch.
It's pretty ugly. And of course, Doug McMillon, the CEO, even said something about deflation, which kind of surprised me.
I know. So many interesting macro stories to kind of pull from that. Also, speaking of macro stories, let's talk about Cisco. Cisco also having a powerfully bad day, I would say, tumbling the most in about 18 months. It lowered its revenue forecast, raised concerns that basically corporations aren't spending as much on technology.
You know, but Cisco is, or should be, a beneficiary of the whole switch to AI and the adoption of AI, but maybe that's already priced into the stock, and it's been talking up that possibility for so long.
Priced in the promise of it, and then you think about how long it's going to take for that to actually benefit the company. Maybe that's happening. All
right, we're less than 1 hour away from the closing bell. We've got cross-platform coverage of today's top stories beginning right now. This is the close.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. I'm Scarlet Fu here with Katie Greifeld. We are joined now by our colleagues Carol Massar and Tim Stanovic. And of course, in doing so, we say hello to everyone, all our Bloomberg audiences across television, radio, YouTube, originals. Hello. Hi, Carol. Hi, Tim.
A big happy family. Here we are.
Friday's Eve.
Friday Eve, exactly. What are you guys looking at today?
Hey, retail, and more retail, right? It's been a week full of retail, and I feel like, we're starting to see some real concerns on both the low end and high end, right? We had Walmart come out, the CFO talking about cautious on the consumer more so than they were about 90 days ago at this time. And so then you also had low. I hate to say lower end. I just feel like they are a wider snapshot of the U.S. economy. So when Walmart, the world's largest retailer, they say something, you kind of sit up and take notice. So you've got them on one end. Then you've got something like a Burberry, who also warned that the annual profit might be at the lower end of their range. They're worried about demand at this point. So I think it's interesting. We thought the luxury end, Tim, was immune to downturns, but not necessarily so.
I'm also watching Macy's because they did report a third quarter profit that beat expectations. Inventory management was better for the quarter. Same-store sales, though, fell for a third straight quarter. It's kind of a similar story that we got from Target yesterday. This improved, quote, operational efficiency, right? So they're doing a better job managing inventory. They're not marking things down as much, but sales are not increasing, and that's certainly a concern, although investors are happy to see, better efficiency.
That's what's interesting here. I mean, both Target, both Macy's, they had lower comp sales. For Macy's, it was the third straight quarter of declines when it came to same-store sales. But the fact that they are managing things better, they're improving profitability, it seems to be enough for stock investors, at least first blush reactions.
Maybe they're just locking everything behind doors.
Wow, what a perfect segue. I didn't even have to fight for that one.
Thank you, note required on that one.
This is one of the most popular stories right now. It's something that you see if you walk into basically a CVS, a Duane Reade, et cetera, especially in Manhattan, that everything is behind bars almost. So you have to call someone over to unlock the case to actually get your toothpaste, et cetera, your Oreos, whatever that is. And it's interesting, you heard from Andrew Lipsman over at Insider Intelligence, quoted in this story saying that the surge in sales that we're seeing in online personal health and beauty categories, that's just because people can't necessarily buy them, at least in the city, at their local convenience store right now.
Yeah, it used to be high price tag items. Now it's just anything that people could put in their pockets and walk away with.
Ice cream, etc.
Ice cream bars behind glass cases.
I tried to buy body wash last night. Not a big purchase. Went into one of the retail drugstore chains. locked up, pushed the button like 3 times, nobody came. I did make a purchase, but I went for a lower end purchase rather than maybe something that was a little bit more costly.
I'm impressed you made a purchase. Most people would walk away at that point because they're like, I can't wait, I have to go.
But it's crazy. And I don't think they have enough workers to actually, help people who want to get stuff behind the bar.
Yeah, so it turns into this vicious cycle. If people are going to stop going to those stores to buy these things because it's too much of a hassle and they're just going to order online, then the stores are, not going to do as well. They're not going to carry that stuff, and you're going to actually see those stores close potentially in some areas if they're not actually making any sales. I mean, at the same time, there is the issue of packages getting stolen when you do order stuff. So, you could just order it online and then the package gets stolen.
That's a question. So obviously they're trying to prevent shoplifting, which makes a lot of sense. They lose money there, but how much are they losing from people saying, I don't have time for this, I'm just going to walk out of the store right now and order it online? How do you weigh that out? I'm sure executives of these drugstore chains are talking about that intensely.
The freedom case, apparently that's a solution.
What's that?
You go into a locker and you get a code or a QR code.
Oh my gosh.
And then you get access.
Sounds like a lot of work to get that body wash.
A lot of hoops.
Doesn't sound like freedom.
It's a little crazy. It's a little crazy. I just want my body wash. Yeah. Okay. All right. We'll be back, guys, in less than an hour's time. We're going to wrap up the Thursday trade. We've got you covered at 4 p.m. Wall Street time. Radio, TV, YouTube, and, of course, Bloomberg Originals. We'll see you at 4 p.m. Wall Street time.
We want to move on to something now that is, of course, something that all sports fans are excited about. Anyone who's a fan of Las Vegas is excited about, because Formula One is preparing to race right through the neon heart of the city of Sin. The 3.8-mile track will weave past world-famous casinos and hotels, with drivers reaching speeds of up to 212 miles per hour. This is a giant undertaking. It required an investment of $500 million. And I'm pleased to say that joining us now is Greg Maffei, CEO of Liberty Media, the parent company of Formula One. Greg, thank you so much for joining us. I'm sure you're very excited. Give us a sense of what the last-minute preparation looks like right now from where you sit.
Thank you for having me. Well, we are all very excited. I think all of Las Vegas is gearing up, and we're ensuring that the barriers are set. We're ensuring that the track is clear and clean, and we're ready to go.
You're ready to go, and of course, there's been a couple of U.S. Grand Prix. There's been one in Austin, there's been one in Miami, and a lot of people say that the Austin one really felt like it was one for the people, for regular fans, while the one in Miami and now the one in Vegas feels more like it's for corporate sponsors, and the ticket prices are a little bit more out of reach. How worried are you that 3 U.S. Grand Prix races might be a little bit too much and differentiating between these different races?
Well, first, I think each of the races has a different character, and they're very have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing. And I am not worried about demand, because we have been lucky enough to see interest in Formula One explode here in the U.S., partly due to Netflix, partly due to social media, partly due to the quality of the product. We've seen increasing fan interest with fans of all ages and all different sorts of levels of attention and knowledge grow as an audience group.
Well, when you think about how to keep that momentum going, how to keep building the sport in the U.S., do you think that F1 needs a U.S. star to do that?
Well, I think a U.S. star would be great, but we don't seem to have a problem. We've had an English star, we've had a Dutch star, and we have a lot of people who love Lando Norris or Carlos Sainz or Charles Leclerc. So there's interest in all nationalities. It doesn't seem to have stopped a lot of interest in the sport.
And so let's talk about, too, how Liberty actually profits from this. So as I understand it, you're the promoter for Vegas, so you have direct ownership of the actual race. How does that turn into a profit, and what's the timeline there?
Well, we have a bunch of big revenue streams as Formula One. We've got broadcast, we've got sponsorship, we have promoter fees where the promoter pays us a fee. There may be some overrides for success. In this case, we are the promoter. So we are taking in all of the local sponsorship. We are taking in all of the ticketing money. We're taking in the hospitality. We will share that with the teams. Obviously, after expenses, we'll share that with the teams.
Greg, I got to ask you about Andretti. Of course, this is another team that the FIA has approved, but Liberty, as the commercial holder of the race, hasn't yet done so. And we know that there's some concerns among other team principals that maybe are against expanding the grid. Do you think it is inevitable?
No, nothing's inevitable. I think there's a process which Formula One will go through. We will look at what a new team can offer. We're blessed with 10 very strong teams, a lot of excitement, but we'll look at how a new team, which would be sharing in the growth and sharing in the profitability of the sport, we'll look and see what they can bring to the table and whether they're the best entrant to expand our team roster.
What are the terms that you're considering? I'm just wondering, what kind of timeline are you operating under in thinking of making a decision here?
Oh, I think you'll see it over the next several months, but we don't have a set deadline.
And so, Greg, I also want to talk about pretty much the sport more broadly. Are you seeing more people try to come in and buy F1 teams? What does that look like?
Absolutely. So Liberty's been involved with F1 for about 7 years now. And literally when we started, the bottom team got sold for £1. Manor went into receivership in the UK, equivalent of bankruptcy, and no one would buy them. And now the bottom teams are probably worth close to $1 billion, maybe $750 million, and the top teams are probably worth $3 billion. We've seen an explosion in prices, and we've seen a huge growth in demand. Most recently, an investor group bought into Alpine, including people like Rory McIlroy and Ryan Reynolds. So not only do we have a lot of investor interest, we have a lot of high-profile investor interest.
More investor interest means an expansion of the sport, of course. I hate to go back to the idea of an 11th team here, but I do wonder the environmental considerations of widening the grid as well. And I'm sure this is something you think about as well. What kind of emissions, pollutions, logistics challenges does that present? And how do you think through doing the due diligence for that?
Yeah, I think the 11th team is just part of our, one of the considerations is that we have a 2030 zero carbon plan. We'll have in the new engine in 2026 comes forth, which is a hybrid engine that'll be with a sustainable fuel. But we're looking to make the whole ecosystem environmentally friendly. 11th team may stress that and add to that a little, but I don't think we could absorb that for the right team because we have a plan that I think is very sound.
All right, Greg, it's great to get some time with you. Really appreciate it. That is Greg Maffei, of course, the president and CEO of Liberty Media. Now coming up, thousands of Starbucks baristas go on strike today, claiming that the coffee chain refuses to fairly negotiate with their union. It's just the latest in a growing number of job actions across the country. We'll have the latest.
Plus, FTC Chair Lina Khan has a warning for private equity. She says there may be more antitrust lawsuits in the pipeline. We'll have the latest.
And earnings season isn't over yet. We'll be watching earnings after the bell, including Ross Stores. All that and more coming up. This is The Close on Bloomberg. Global stocks will outperform bonds in 2024 as they navigate a soft-ish economic landing. At least that's the view of Barclays. Strategists over there writing that, quote, we think stocks will benefit from a fairly benign bottom to this business cycle and look through near-term earnings disappointments. Here with her perspective is Lucy Baldwin. She is Global Head of Markets Research and Equity Advisory over at Citi. And Lucy, it feels like soft-ish, soft landing calls have really gained a lot of traction in the past week or so. What's your current view on the idea?
Katie, great to see you. Thanks for having me. Well, look, we came into this year pretty pessimistic, and like a lot of pessimists, we were kind of wrong on that, right? The economy has withstood a lot of pressure. The tightening has obviously accelerated as the year has gone on. I think people increasingly feel we're at peak rates. And I think the inflation data that we're seeing come through now is obviously causing some to declare victory, right, in terms of the Fed has done what it needs to do. I think our perspective on that would really be, Katie, that yes, the signs are pretty good for peak rates, but the curveball risk almost into next year is that you get another hike and that some elements of the inflation data are still a little stickier and maybe a bit more transitory, than people realize. So I think as we look into next year, we do see growth slowing from here, but it's with that caveat that really we were too pessimistic coming into this year, and actually the US and even China, we've ended up having to upgrade those expectations. So as we look to next year, we would be in the recession camp for the US, but very mild. We just feel that a soft landing is incredibly difficult to pull off. But I do think what you're seeing right now is going to give a lot of people hope that we're back in a kind of Goldilocks scenario for markets, and that actually this is a bit of a turning point for risk assets into the back end of this year.
So let's talk a little bit more about that. Say we do get that view that the U.S. does enter into a recession, but it's very mild. How do you invest around that? Did the typical recession playbook still work in that environment?
Well, look, we actually really rather like the S&P here. We like large cap stocks in the US, right? So when we look into next year, we've basically got around 10% earnings growth that we expect to see coming out of the S&P next year. We've had about 16 months of earnings recession, don't forget, in the US, right? So we see that corporate profitability really starting to turn. So we've got a target of 5,000 for the end of the first half. And that, again, is predicated on that slight recession coming through. So if you were to get a softer landing, there'd be upside to that. So we do really rather like equities here. But we also recognize that's around 10% upside between now and the end of the first half. You've got a very credible challenger there, obviously, with cash yielding you north of 5% now around the world. What I would say as well, from a diversification perspective, is things like government debt. We particularly like US, Europe, and EM debt. We think there's a lot of attractions to be had there. So I wouldn't just say it's all about equities, and I would still say within equities, you've got to be a bit cautious. So just to give you a quick sense, in the US, we think some of the mid-cap stocks actually are more value traps, right? Because we think the growth rates there that they're delivering are less attractive. The volatility of their earnings stream is much greater than it used to be. And so that sort of valuation discount versus the large cap names, we feel very much warranted. For us, tech is a big overweight, and we upgraded coming into the fourth quarter. We think tech still got a way to run, both sort of internet and software. We think that would be a great place to be into the end of this year. But I do think, obviously, recession takes hold. If that does happen for us back end of the first half, then you'd have to reassess how things look then.
Right, and just kind of back up your view right now, you're looking at a Russell 2000 that is underperforming the broader markets, and the NASDAQ doing a little bit better than the S&P 500. Going back to your economic outlook and perhaps a mild recession, is that consistent with the kinds of downbeat and somewhat cautious outlooks that management have been giving in their earnings outlooks when it comes to kind of projecting out their growth forecasts, their funding needs?
Yeah, look, I think so. I think the reality is, the higher rates are clearly starting to bite, but you would expect that, and you needed to see that coming through, right? I think it's very difficult to not see unemployment rates tick up as we go into next year, even in the US, right? And I think it's pretty consistent the world over, right? Europe would be, to our mind, in a recession now that started in the third quarter. We think that'll run all the way through that first half. We think the UK will enter a recession. So I think, we see that pressure everywhere, and I think that's pretty consistent with the messages that we're getting out from corporates. But we're almost in a zone where good news, as long as it's not too good, is good for markets. At the same time, bad news, as long as it's not too awful, is becoming actually quite good news as well.
So, Lucy, I wonder how your clients are positioned right now. Are they looking for reasons to take on risk, or are they looking for reasons to de-risk?
Yeah, that's a good question. And I think, it's quite a broad spread of views, right? I think a lot of people like us were very bearish at the beginning of the year. And so, I think for a number of people, if you do see this risk on trade continuing into the back end of this year, that they're probably not that well set up for it in general cases. Just to give you an example, right? Like everything we've seen in the last 24, 48 hours around China, US with Biden and Xi. Lots of clients asking, what does that mean, right? You know, China is a massive underweight for most fund managers, right? Sort of 400-500 basis points worth of underweight. And even if you were to see like a 200 basis point change in that, that's probably about $160 billion worth of flows into that market. So certain parts, I think people are really not set up to see big shifts in, you know, whereas I think really, US equities has been, you know, more of a consensus overweight for pretty much the last decade.
Lucy, really appreciate that last anecdote there. That was really enlightening. Lucy Baldwin is Global Head of Markets Research and Equity Advisory at Citi. From New York, this is The Close on Bloomberg.
All right, we've got about 35 minutes to go until those closing bells ring. You take a look at the S&P 500 right now. There's actually not too much to look at. It is almost exactly unchanged. You take a look at the NASDAQ 100 as well, also pretty much unchanged on the day. It's been a big week, to say the least, Scarlett. Of course, CPI 2 days ago still looms large. We're starting to see things quiet down just a little bit, though.
Yeah, but the rally in treasuries continues, and you see the yield coming down for the 10-year, well below 4.5% right now. And crude oil falling is pretty significant, given that the recent rally had been a source of concern for a renewed inflation.
Yeah, some pretty amazing moves when it comes to the bond market, when it comes to the energy market, but not having too much shock value when it comes to the equity market. Much more coming up. This is The Close on Bloomberg.
Just under 30 minutes to go left in the trading day. And right now, Katie, you look at equities, not a whole lot going on.
Remarkably unchanged if you take a look at the S&P 500. There's slightly more action when you take a look at the circle of sectors. You have 7 sectors in the green, 4 in the red. You take a look at what's doing well today. Utilities, communication services, and technology squeaking out some gains here. You take a look at what's not doing well. Consumer discretionary, consumer staples, and then down at the bottom you have energy off by over 2%, of course, as oil continues to fall.
All right, it is time now for our Wall Street Week Daily segment. Larry Summers, the former U.S. Treasury Secretary, spoke with our David Weston yesterday about what we can expect out of the talks between President Biden and Xi Jinping. Take a listen.
Look, it's important to have meetings like this. Churchill famously said, much better jaw-jaw than bang-bang. On the other hand, I think we need to remember that there are very difficult fundamentals here. Very different systems, very different views of the world, profound competition in the technological arena, concerns on the American side about China's subversion of our vision of the international system, concerns on the Chinese side that the United States is trying to hold them down. So there are very profound geopolitical forces at play, and this struggle is going to be with us for a very long time. So I'm glad to see the meeting, but I'm concerned, and I'm particularly concerned in light of the gravity of the economic challenges that China is facing. And my concern is that, as with the Soviet Union in the 1960s, a sense of very serious economic challenges is going to drive a felt need for increasing assertiveness in the international arena, as we saw with Khrushchev's moves on Berlin, as we saw with the placement of missiles in Cuba. And while I don't see anything concrete like that that's happening right now, I think the economic distress and the link to nationalism, given some of the very strong positions that Xi has taken, is something that is going to require the United States and the West to be on their guard going forward.
Global Wall Street's paid a lot of attention this week to those CPI numbers that came out for the United States. Some people are, if not declaring victory, close to declaring victory over inflation. Are they premature?
Look, those were good numbers. Those were better numbers than I would have expected, better numbers than I think most people would have expected. And I think inflation performance has been more favorable, certainly than I have expected over the last year. And I've thought a lot about that, David, and I think there are 2 or 3 factors to emphasize. The first is that policy has been much tighter than was anticipated. In July of 2022, markets were assigning a probability of under 10% to the level of tightness in policy that we have seen so far. So more tight policy has led to better outcomes on inflation. That doesn't mean inflation fears were unwarranted. It means that people took the fears seriously, which was good. I think that's one important aspect. I do think that given how strong the economy has been, there's still a surprise in what's happened to inflation. And that, I think, has to do in part with transitory factors that were pushing inflation up from bottlenecks that are now mean reverting and are pushing inflation down. So I think there's been a little bit of prematurity in some of the declarations of victory. And I'm not sure the inflation figures over the next 2 years are going to be quite as favorable as the market is expecting, especially in light of the geopolitical risks around oil and some other commodities. So we'll have to see whether we're really able to get down to 2% quite as easily as many people imagine. And that's an aspect of this situation as well. And I think the third thing to say, David, is we don't really have a completely clear sense of where the economy is right now and where it's going. So I still think a soft landing is a difficult outcome. It still would not be my prediction, even as I'd recognize that it looks more plausible today than it probably did 6 months or a year ago.
More plausible, but there are those economists who are warning that some indicators actually are tipping more toward recession than perhaps the markets are anticipating. For example, the SOM rule, which is one measure of it, is not that far away from actually pointing toward recession, and there are other indicators as well. What is the risk right now of a recession in the first half of next year?
It's certainly under 50-50, David. I think it's probably on the order of 25% that ultimately something will happen which will cause the NBER to date a recession as having begun in the first half of the year. In general, when recessions come, we don't even know that we're in them till they've been underway for several months. So I think you got to recognize that as a real risk. On the other hand, with what we've been seeing in the employment reports, incomes are continuing to grow. So I don't think that is the preponderant scenario. I was a bit surprised when early in the week you saw retail stocks on fire, suggesting that the possibility of recession was coming completely out of the market. And that doesn't seem smart or wise to me as a market response. You know, I think that some people may have too much confidence in Mother Fed.
That was the former U.S. Treasury Secretary Larry Summers, of course. And as a reminder, watch more of our conversations on Wall Street Week, Friday at 6 p.m. Eastern Time with our David Weston. Katie?
Coming up, Lena Khan has a warning for private equity. Part of Bloomberg's interview with the FTC chair next. This is The Close on Bloomberg. This is the countdown to the close. I'm Katie Greifeld alongside Scarlet Fu. And let's talk about Lina Khan. She has warnings for the private equity world. The FTC chair spoke on Bloomberg's Odd Lots podcast. Take a listen.
We can look at, businesses across the U.S. economy and how they're structured and what their particular business model is can vary. We've been particularly focused on healthcare markets, but especially after we filed this lawsuit, we've been hearing from market participants across sectors about additional areas where they believe that, we should be scrutinizing, be it in healthcare or elsewhere.
For more, I'm thrilled to say we're now joined by co-host of Bloomberg's Odd Lots podcast. We're talking about Joe Weisenthal. He's here on set. Joe, tell us about Lina Khan. Usually I think Lina Khan, I think Amazon, but she's focused on healthcare. She's focused on roll-up strategies.
Yeah, as you said, most of the attention on this FTC or a lot of the antitrust action that we see these days is sort of, big tech focused and attempts to sort of bring the power of big tech to heel. But there's other stuff going on in the world, and earlier this summer, or I think it was September, the FTC filed a suit against this company that had rolled up a number of small anesthesiology practices around Houston and other areas, had a private equity sponsor. Their allegation is that the company took a huge stake in the regional anesthesiology market and then used that power to jack up prices. And what's interesting about this is it's sort of what we think of as antitrust, right? It's sort of like the classic old school thing you think of. It's not some novel legal theory. It's not really about power. It's just they captured a lot of market share, and so says the allegation, raised prices. So it's interesting to hear sort of like going after like what could be considered, I think, like a bread and butter strategy for a lot of PE.
Well, that's what it comes down to, right? PE buying on multiple businesses and wringing out efficiencies, and in the process maybe discovering that they have all this pricing power and doing something about that. What else does PE do? If Lina Khan says they're looking into that across industries, that's kind of terrifying for them.
Right. I think so. And the other thing she said is, okay, like I said, in this instance, it's kind of, the claim is pretty straightforward.
Okay.
Gathering a lot of market share, using that market share to raising prices, according to the lawsuit. She also says that they made agreements with some of the smaller competitors in these markets that made things even less competitive. But I don't think that that has to be the only playbook that would get on the FTC's radar. And one of the things that we talked about, too, was monopsony power in labor. And so the idea that what if a roll-up, a PE roll-up, ends up being the only employer for a certain type of job within an area or within a market, however that's defined. In theory, that could also be something that runs afoul of the FTC and its pursuit of more competitive markets.
Joe, what is hipster antitrust?
I think it's kind of a pejorative to describe that critics typically use to describe the sort of current generation of antitrust thinkers in which there's sort of the idea is that there are other harms of power beyond just what we think of this sort of building up the market. And I think when you look at a situation like Amazon, there's market power. It's not necessarily about raising prices. In fact, one of the issues with tech, which makes it interesting, is that some of it is about lowering prices. Right. Some of these services don't charge anything at all to the end consumer. So if you just sort of go in with that mentality that it's all about monopoly pricing or something, then obviously that wouldn't apply. And so it's about rethinking. Of course, the practitioners of current antitrust, such as Lina Khan or her counterpart at the DOJ, they deny that they are engaging in some big rethink of what antitrust is, but this is the claim of critics.
What does she think about the fact that companies and lawyers have to think differently about how they pursue M&A now?
I think she says that's the real win, right? Because there's going to be a limit to how many suits they file and so forth. But when you think about enforcement, when you think about, okay, you're a legal entity trying to stamp out what they see as anti-competitive behavior, as she puts it, in the past, according to lawyers she talked to, the anti-competitive aspect was late in the conversation in the deal talks. Now she says it's becoming first and foremost, is this going to get on our radar? And I think to them that's a huge win and makes their lives a lot easier, furthering those goals of competitive markets.
All right. Bloomberg's Joe Weisenthal, co-host of Odd Lots podcast, and be sure to listen to Joe and Tracy Alloway on Odd Lots wherever you get your podcasts. Still ahead, we're counting you down to the closing bell. JoAnne Feeney of Advisors Capital joins us next. This is The Close on Bloomberg.
This is the countdown to the close. I'm Katie Greifeld alongside Scarlet Fu, and a pretty boring day is almost over.
Yeah, I kind of wanted to see more action in equities, but it's not happening here. We had data that shows disinflation is intact. The labor market starting to feel the pain of all those interest rate increases, you know, slowly but surely. And so does that create a Goldilocks economy and a soft landing? Seems like that's the case, right?
Seems like that's the consensus at least. Let's get into it now with JoAnne Feeney. She is partner and portfolio manager over at Advisors Capital Management. And JoAnne, of course, I do want to get your views on the broader economy, the broader market as well. But let's start actually with a scoop by our own Bloomberg's Marc on Apple. Basically, its multi-billion-dollar push to replace Qualcomm chips in the iPhones seems to be losing ground, seems to be stumbling a bit. When you think about what that means for Apple, what it means for Qualcomm, what are your initial thoughts?
Yeah, Katie, you know, the story of Apple trying to switch away from various chip suppliers has been going on for a few years. Qualcomm was the first, and then it became a question of whether they could replace some of the Broadcom chips. And the stocks of both of those companies responded negatively when that news came out. And since then, we've seen some recovery, because it turns out it's really hard to make these chips. And, you know, Qualcomm provides the main engine, communication engine in the iPhones. And it's just a really complicated chip. And Broadcom provides some of the filters and other chips inside the phone, also very complicated to manufacture. So, you know, it just means that Apple's going to continue to use Qualcomm. It's really not going to affect them all that much. I mean, they would have liked to have sourced more of the parts of the iPhone internally, because they can grab the profit margin off the chip side as well. So they're not going to be able to do that. But, you know, it's good for Qualcomm. That stock's one that's sort of been flattish this year. It's been up and down a bunch, but it has suffered a discount because of this fear that Apple was going to switch away next year. Now it looks like it's going to take Apple longer. And similarly for Broadcom. They also saw a little bit of a hit when that news came out. And since then, we've gotten better news out of Broadcom saying, no, Apple has signed up for another X years. And so it just turns out, you know, it's important to understand the technology behind these chips when you're making these kinds of investments. These are both names, all three, in fact, that we own for clients, because we're looking at the longer term. And the challenge of these technology evolutions is a significant one. And so for some companies and some kind of products, you can count on the companies retaining these wins for a long period of time and the margins that go with them.
And you mentioned, of course, that Qualcomm had been trading at a little bit of a discount when we think about some of these broader concerns. Let's talk about, though, the semiconductor industry overall. Really, the whole sector has been on fire this year. One of your biggest winners, of course, paced by the likes of NVIDIA. How are you thinking about that leadership going into 2024? Do you think the leaders that we've seen so far in 2023 will continue to be the winners next year as well?
You know, it's a tough situation in semiconductors, as it is with the whole market, because it's been very, very narrow, the leadership. It's been led by NVIDIA, and you're seeing less positive behavior in companies like a Texas Instruments or a Microchip, for example. And I think when you look to 2024, a lot of the evolution of the semiconductor industry is going to depend on the broader global economy. Now, we're getting news that suggests that the soft landing is becoming increasingly likely. But we're also hearing of a continued slowdown in some of the key semi-end markets, like industrials, for example. While we're seeing recovery in personal electronics, we're seeing still a growth in autos. Industrials is a big area. So we have to really think about what the global economy is going to do. And so at Advisors Capital, right, we're looking both at the top down and at the bottom up to select the right stocks for that eventuality. Right now, you know, we're in the camp of soft landing is the most likely. And we think there are some real opportunities in the semi space at this point, given how much some of them have traded off this year.
Okay, so you have increasing likelihood of a soft landing for the U.S. economy. You also have what appears to be thawing relations between the U.S. and China. We heard President Biden speak earlier this afternoon, and one of his messages to the CEO summit at APEC was that the U.S. does not seek conflict, and U.S. and China are resuming military-to-military communication. A stable relationship between the two countries is good for the rest of the world. How does that affect your thinking of how to invest in China? Does China become more investable because of this?
Yeah, you know, I think, Scarlett, that the fear about China is probably going to be maintained a little longer. While it's great to see a bit more stability enter the relations between the U.S. and China, you know, particularly on the political side, the military side, I don't know that companies are going to jump right back in and say, okay, now I can go source everything I need from China because it, might have the cheapest price. When I talk to some of the companies involved in the semiconductor and technology, what I hear is we need to diversify. We need to source from multiple countries so that we're not vulnerable to shifts in the political winds.
How far along in that process are these companies in de-risking from China, in diversifying their supply chain to other countries, like, for instance, in India?
Yeah, it's hard to know, partly because different products have different design periods. So if you're a car company and you say, I don't want to rely on China for this part, then I need to go start working with another design company in another country that needs to work over many, many months before you can actually design it into a new product. So it's going to really vary by the end user, but clearly it's been underway now for quite a while, ever since really the previous administration started imposing tariffs on Chinese imports.
JoAnne, I want to come back to the U.S. because really for most of this year, all of this year, and really most of the last decade, this has been such a macro-driven market. It feels like we cannot escape the Fed. It seems like now, looking at the consensus, is that the Fed is finally done when it comes to its rate hiking campaign. Do you think it's possible to move into a post-Fed world, or what's your outlook for what actually is the driver of markets going forward?
Yeah, I think while it seems to be the case that a soft landing is more likely, that's a baseline view, I don't think you want to take all of the probability weight off of the chance that the Fed has more work to do, right? We are still seeing a relatively tight labor market. Yes, unemployment claims went up a little bit today, but job openings are still exceedingly high relative to the number of people looking for jobs. So while, it's clear the Fed has paused because real interest rates have risen, financial conditions are tighter, right? We're seeing inflation come down. If the labor market remains as tight as it is, if that wage pressure remains as persistent as it has been so far, we could see the Fed still having more work to do. So you don't want to sort of jump from one side of this fence to the other. You want to have a recognition that there's still risk, that these interest rates are going to remain higher for longer. The market might be getting ahead of itself in the number of rate cuts it's priced in for next year. And so for the market equities as a whole, I still think it's a selection question. It's not whether the whole market's going to go up or down. It's whether certain companies can survive and thrive in this kind of an environment.
All right, JoAnne, that's a good place to leave it. Really appreciate your time today. That is JoAnne Feeney of Advisors Capital Management. And of course, we're counting down to the closing bell right now. You take a look at the S&P 500, pretty much unchanged. We're going to bring you full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlet Fu counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast. We're joined now by Carol Masser and Tim Stenovic. We bring together all of our audiences as we do so. And Carol, it looks like we're actually going to finish in the green today on the S&P 500, but just barely.
I feel like it's boring on the equity side of things. I think where the interest is really kind of on what you guys always like to talk about.
The bond market.
Exactly, right? We saw yields back off after that weaker jobless.
I'm sorry, do you know who just walked by, Carol? Romaine. He just walked by and looked in here over your shoulder, Carol, as you were doing the simulcast.
I'm now looking over to see if he walks by.
You can't keep this guy away.
What's up with that? What's up with that?
I think it's okay.
He's going to make a guest appearance a little bit later on. He is speaking with a special guest.
Markets are so boring today, I have to come in and shake things up.
I thought he had the day off. This is what happens. He's so excited. I'm sorry, Carol. I interrupted you.
No, that's okay. Take it away. Where are we going?
I'm sorry. I wanted to talk about what we heard from Michael Sheldon over at RDM Financial Group, Hightower RDM Financial Group. He said that, I think it's kind of clear at this point. The tone of the market has just completely shifted since late October. And it sort of seems like each day we get more and more evidence, whether it's data, whether it's CEOs of companies telling us that, okay, we are indeed seeing cooling. We're seeing it back, kind of seeing what the Fed wants to see. And look at the way that equity investors have reacted to it.
He says market internals are improving, which is kind of interesting.
Improving, perhaps. We'll see. You take a look at market internals today, about 10 seconds away from those closing bells. The S&P 500, again, a very slight gain, up about 13% on some softer volume than normal. You take a look at the NASDAQ, same story there, up about 0.1%. You take a look at the Dow, again, small moves here. The Dow finishing about 0.1% lower, Carol. And it just feels like all the fireworks are at the start of the week.
Yeah, Russell, though, man, that was taking a little bit more of a beating. If you look on a percentage basis, compared with the kind of other indices, the larger cap indices, small cap Scarlet down about 1.5% in today's trade. So a little bit of a pullback.
Yeah, even if you do think that the U.S. economy is going to go through a softish landing, perhaps a mild recession, that idea the economy will hold up better than most, small caps are looking more and more like some kind of value trap because they're just not getting the bid that you thought they would. By the way, Carol, you mentioned since late October, or Tim, you did, the S&P 500 has seen 14 trading days. It's gained in all but 2 of those days, up 9.5% in that period. So pretty remarkable.
That's amazing. That's like a year. That's like that would be a good year of gains in the S&P 500 happening in what, 12 trading days, Scarlett?
14 trading days.
Wow.
Yeah, so let me just walk you through what's going on here very quickly. You have the 24 industry groups, pretty mixed day given where we are with the S&P 500. Insurers, software, and media entertainment leading the way, each up by at least 0.9%. On the downside, you've got food and staples, that's Walmart, autos, and energy stocks. Energy stocks, of course, really getting hit because of the drop in oil prices.
All right, guys, let's get to some of the individual gainers. Intel, top in the S&P 500 and the NASDAQ 100. They got an upgrade by Mizuho to buy from neutral, saying the company was lining up significant new server products in the next 6 months. Upgrade specifically reflecting a PC and data center rebound in 2024, so next year, and a better compute and data center product roadmap. That's coming from the analysts over there. Price target set to 50 from 37 a share. Stock closing at about 43 and change today. That's the number one gainer in the S&P 500 and the NASDAQ 100. The number 2 gainer was Intuitive Surgical, which has been under pressure. All of these companies that have been under pressure as a result of the rise in this new class of weight loss drugs. So you're talking about glucose monitoring companies like Dexcom. Intuitive Surgical has also been under pressure. It dropped about 27% from mid-July to the end of October. Well, investors are buying it once again. It's up about 16% since the end of October, but rallying in today's session, as you can see, up about 3.5%. No real news, but it's just interesting that investors continue to move into it. Retail, we've been talking about it. You guys have too. Got to do it. Macy's, definitely one of the outperformers in today's session, up almost 15% at its highs today, finishing the day just shy of a 6% gain, better than forecasted profit, and that's despite comp sales down for a consecutive third straight quarter. We talked about this earlier, right? Better inventory management. That really helped out during the quarter.
All right, well, let's go to some of the decliners on the day today. You talked about Macy's rise, Carol. I'll talk about Walmart's decline. Shares falling 8% today, the most in more than a year. This after the company expressed concern about the outlook for U.S. shoppers after signs of weakness in the second half of October. The company's CFO said that there was, quote, sharper fall off in sales during the last 2 weeks of the fiscal third quarter. That ended at the end of October, of course. Higher interest rates, dwindling savings, student loan repayments, all of those things went on demand. November, though, off to a good start. This was the second worst performer on a percentage basis in the S&P 500. The worst performer on a percentage basis in the S&P 500 today goes to Cisco Systems. It's the largest maker of networking equipment. Today, it tumbled the most since May of last year. That's about a year and a half, falling 9.8%. Its revenue forecast raised concerns that companies are reining in their tech spending. Let's look at shares of Carvana. This is an interesting one today. How about Amazon priming your next car? What do you think of that, Katie?
What do I think of that? I think Romaine Bostick is actually offset, trying to distract me. I want to talk about yields.
Okay, well, I'm not going to you quite yet. Okay. Shares of Carvana falling today by 5.3%. Legacy auto dealers slumping today after Amazon announced an online car sales partnership with Hyundai Motors.
All right.
So you could order that car on Amazon at some point soon.
She has a Honda.
Do I talk about yields now?
You can.
Yes, please.
Or your Honda.
Or my Honda. Let's go with yields because, again, like Carol said, all the action was in the bond market today, and it was actually in a good way. You saw a big rally coming into the bond market, pretty even across the curve. 2-year yields down about 7 basis points. 10-year yields down about 8 basis points. Take a look at the level on the 10-year, 444. Remember when we were above 5%? I barely can. This is the lowest level in really about 2 months since the end of August or so, and it really just speaks to the whiplash that we've seen in the bond market. But it feels like people are really buying into that soft landing narrative. Maybe the Fed can have its cake, eat it too. And you're seeing a lot of, I don't know if you could call it panic or agita get priced out of the bond market right now.
For now, because it could all change tomorrow.
That's very true.
All right, let's take a look at what's going on with earnings, because Ross Stores, another off-price retailer, has just reported earnings. It is rising in the after-hours trade after third quarter EPS topped analyst estimates by 11 cents, $1.33 for the fiscal third quarter. Comparable sales rose 5%, better than the expected 3.1%. As for the forecast, Ross Stores sees fourth quarter comparable sales rising 1 to 2%. The previous estimate was for 2.3%. And it also sees full year EPS of $5.30 to $5.36. That is an increase from its previous range, and analysts are below either ranges of $5.27. So the stock moving up by 3.6%, kind of a contrast to TJX, the owner of TJ Maxx, which also had a beat and raise quarter, but perhaps a lot of people were expecting more from TJX.
Well, and I'm looking at the press release. The CEO, Barbara Rentler, commenting. She says, "We're pleased both sales and earnings outperformed our expectations for the quarter as customers responded favorably to the terrific values we offered throughout the store." Operating margin, she says, as Scarlett, you just mentioned, was up 11.2%, up from 9.8% last year. She said as leverage from the same-store sales gain and lower freight costs were partially offset by higher incentives and store wages.
Okay,
so there's some different things going on, some
but
dynamics.
think about what she's saying there. I mean, even though fuel costs were lower, they still had to put stuff on sale more, Katie, in order to attract people into the stores to buy those things. And then, of course, you have the wage story coming into this. So, and she's still feeling pressure on the wage front, and that's going to hit margins.
Yeah, there's honestly a lot of cross currents to parse through reading through this release. Again, you take a look at the after hours action and it seems uniformly positive. I don't know about you guys. We've been watching retailers report all week. It feels like there's not one narrative that we can settle on. It feels very idiosyncratic.
Except for inventory management.
True.
That's it.
Yeah, but even then, like if you want people to buy in your stores, you need to provide a good experience, and that does mean staffing up, because you can have all the inventory there, but if you don't have the staff to push those sales through, people will just get fed up and walk out, as we're talking about in the last hour.
No, it seems like it's all over the map, so it's going to be very interesting. We just talked with two members of the Bloomberg intelligence team who said, you know, it's a reminder. It's called Black Friday because it's when retail turns profitable for the year. That fourth quarter is so important, even for a retailer like Walmart. So this last quarter is going to be really important for these guys.
Yeah, and the fact is people right now, in order to save up to actually buy stuff this holiday season, they're pulling back on other spending, potentially spending in the services category. So think restaurants are not eating out as much or spending as much money at these restaurants, so they can actually buy things this holiday season.
Yeah, although if you trust Walmart and you believe what Doug McMillon is saying, maybe those things will cost a little bit less in 2024.
Yeah, well, too bad that's after the holiday quarter, right?
So where's the narrative, right? Like that's the point, right? It's like kind of, it feels like all over the place, which is why the market's kind of
that makes a market.
Here we go.
It does indeed. All right, guys, have a great weekend because Tim and I are not going to be here tomorrow. So
don't tell me that. Scarlett will be here though.
I'll be on radio. I'll be one of you.
Scarlett's yes, exactly. She's going to be holding down the fort for us. That's going to do it though on this Thursday. Our cross-platform coverage on the markets, Beyond the Bell. We call it at 4 p.m. Radio, TV, YouTube, and of course Bloomberg Originals. We'll see you all tomorrow.
All right, coming up, we have musician and entrepreneur E40. He is in Bloomberg studio. He's going to talk about his new album, as well as his business ventures in the food and beverage sector. Romaine Bostick makes a special guest appearance to speak with E40. This is The Close on Bloomberg.
This is The Close on Bloomberg. I'm Katie Greifeld along with Scarlet Fu. And joining us now for a special conversation is our own Romaine Bostick. Take it away.
Yeah, I'm sitting right now down with one of the most prolific musicians out there, a legend in the hip hop and music community. Rapper E40 is an icon to say the least, but he's also a businessman. He's also a chef as well, merging his passion for culinary arts with his entrepreneurial spirit. He's got a new album out today called Rule of Thumb, Rule 1. I assume there's going to be a Rule 2 and 3 as well. He's also released a new cookbook called Goon with the Spoon, a collaboration with Snoop Dogg, which features some of his favorite recipes. Pleased to say he joins me now here in Studio 2. Great to have you here.
Great to have you, buddy. Thank
To
you.
say that you're prolific would be an understatement. I mean, we're talking, what now, 27 solo studio albums, and that doesn't count all the collaborations and group projects you've done. Why are you still rapping?
I like that. I have a passion for rapping, man. You know, this is it. I played the drums from 4th grade all the way to 12th, and that's before they had Pro Tools and, you know, those type of things that can get a song out there right away. And but I just always had a passion for rapping ever since I heard the Sugar Hill Gang in 1979.
You also had a passion for cooking. You have a cookbook, Goon with the Spoon.
Absolutely.
And you maybe kind of give us some insight into why you actually chose to write a cookbook.
Well, I started off on IG, cooking with the Power Pressure Cooker. I had a song we mentioned, me and my cousin B Legit, he had mentioned I'm a goon with the spoon.
The beast with the mouthpiece.
Exactly.
Yeah, all right.
You know, so
Yeah.
you know how like a basketball player or a football player, they might say, oh, he's a dog. That means he's a dog, like he's a beastie or whatever. You know, it's a good thing. They turn something that sound bad into something good. So I'm the goon with a spoon. I'm a goon with a spoon, you know what I'm saying? So anyway, I started, I had a logo made with a vector for the Goon with Spoon logo, and I had it put on all every time I would post something on IG, like my food, whether it's short ribs, whether I'm making gumbo, whether I'm making oxtails, whether I'm making meatloaf or whatever I'm doing, you understand me? It just started getting a lot of attention, and here I am co-packing now. I co-pack. What I mean by co-packing is I have ice cream, Goon with the Spoon ice cream, and like Safeways, Walmarts. I have sausages in Costco's, you understand, burritos, and you know, sky's the limit. And the book, Snoop Dogg, presented the book because he had already had a book out.
Right.
And so he was like, hey, Earl, let me put your book out, buddy. You know what I mean?
You mentioned some of the food products that you have, the sausages, the ice creams. How did that go from idea to actually getting it onto the shelves of a Safeway and a Walmart? Was that a laborious process?
Well, I do my due diligence. Once you're in a certain space, it's you just find people that can get it done for you. I own all my stuff 100%. I sell food.
Now, when you say 100%, you're not going out looking for financial backers?
None at all.
Okay.
None at all. 100% black owned. I also have, I'll go by my real name, Earl Stevens. I have wine up under Earl Stevens. You can find it in many stores, your local stores, the Costco's, the Bev Mo's, the Total Wines, all that, right?
Yeah.
So I have that, and I have the spirits, Ecuador Tequila. I have Kuiper Belt Bourbon. I have Tycoon Cognac, all up under my umbrella.
Yeah.
So I'm in that food and beverage space.
Is that primarily where you're putting most of your money in food and beverage, or are you looking sort of outside that realm as well?
Well, I'm comfortable in this space, and you know, music is really my first love. You know what I mean. Also, I'm in like 50 to 60 startup companies. One of them being SpaceX and Clubhouse, and you know, I do it from I get at them from the beginning, and you know.
Well, I want to talk a little bit about that too, because a lot of people don't know just how prolific you've been in that space as well. But that hasn't always been a part of your career.
No.
That's relatively new, at least considering how long that you've
Since
been
2016,
rapping.
I've been doing.
What was the pivot? Why did you make that pivot then? What was the revelation?
Well, I have a friend by the name of Chameleonaire. He was already in that space. He's a rapper too, and he pivoted into
That's Hakeem,
startup
right? Yeah,
Hakeem, absolutely. A good friend of mine, really smart, and he got me into it. And I follow his lead. He's a good guy, and it's very smart.
Was the decision though to start sort of pursuing some of those opportunities? Was that about diversification beyond just music and whatever sort of food ventures you had at the time?
I think it's a smart business move because you know tomorrow I can wake up and one of the business out of those 50-something businesses that I invest in, they might get acquired, or IPO, might wake up with a big bag of money.
Yeah.
It can happen overnight.
Right.
It can happen real quick.
Well, that's venture capital.
There you go, baby.
It's like a dice game, and you know, 20 things go bust, and one ends up well. But how do you make a decision as to what to go after? I hear SpaceX. Obviously, that's kind of the golden goose for a lot of people. But how are you making those decisions?
Well, we try to make, we try to find out like those who have already been in that space. We try to, get in those companies where people are seasoned already that has done this before, and we want the evaluation to be under 50 million. most of the time. You know what I'm saying?
So you're basically angel status.
Yeah, absolutely.
As an
there
investor.
you go.
Yeah.
I'm also an investor in Republic too. You know what I'm saying?
Yeah. And I'm curious too, I mean, for all the successes that you've had some businesses that didn't necessarily turn out into a big thing. I was looking back and I almost forgot about 40 Water, which was kind of like a vitamin drink, energy drink, if you will, kind of before they really got popular. What happened there? Why did that not actually gain more traction?
Well, that right there, I didn't have control over that. That was a guy brought that to my attention and he wanted to do it. And that's when I really knew that, hey man, I know I can do this because you know, I'm a very smart man, but it was around 2008, the recession kicked in. I owned a Fat Burger with the late Chester McLaughlin out there in Northern California. There was only 2 of them. One was in Thunder Valley Casino. Another one we had in Pleasant Hill. I didn't own the one at Thunder Valley Casino, but I owned the one in Pleasant Hill.
I gotcha.
And I was co-owner with that with Chester.
You mentioned Fat Burger. I was also going through your portfolio, and you're an owner of a Filipino restaurant. Did I get that right?
Yeah, I'm co-owner of that too. That's
okay.
So that's the it's called the Lumpia Company. My man Alex Rototo.
Okay.
I've always had a passion for Filipino food.
And that's based out in Vallejo, where you're from?
Yeah. So in Vallejo, we have many Filipinos. I grew up playing baseball with them, everything. So the aunties after baseball, you know, they'll make lumpia, and it was just something that we just loved, and it's one of my favorite dishes.
Yeah.
And
well, how do you take that though because it's one restaurant now, more or less,
right now
right?
It's one.
So you have ambitions. Have a food truck too. Okay, but you have ambitions to turn this into a chain.
I want to turn this into like a McDonald's or Taco Bell or whatever, a chain store.
Okay.
So we're just gonna take baby steps, and then we'll start bringing in some investors and whoever, you know what I mean?
Okay.
We start franchising that thing. Very soon, I think it's going to happen.
So what's next? I mean, you already have a lot on your plate beyond this. I assume that you still have another chapter ahead, right?
Well, music is my passion.
Yeah.
Music is what I love to do. That's my baby right there, because that's what make everything spin. You know what I mean?
Yeah.
Because
the economics of that are working for you? I mean, it's changed a lot since 1993.
Very lucrative.
Yeah.
For me.
All right. Well, it was a pleasure to talk to you, E40. Also known as Earl Stevens, rapper, entrepreneur, cookbook author, and I'm probably going to add a few other things to that in due time. Back to you, Scarlett.
All right, thanks so much, Romaine. Great conversation. Some breaking news here. Applied Materials is, of course, the largest U.S. maker of chip-making equipment, and it is down in after-hours trading on a Reuters report that it is facing a U.S. criminal investigation for violating export restrictions to China. This is over its dealings with China's biggest chip maker, which is Semiconductor Manufacturing International, SMIC. So again, Applied Materials lower by 6% right now. We also want to bring you earnings out of Gap. It looks like the retailer reported better than expected numbers for the fiscal third quarter. Comparable sales fell less than anticipated, and in fact, at Old Navy, unexpectedly rose. And so as a result, that stock is up more than 7.5% right now. We'll have more details on Gap's earnings after the close, or after this next break. This is The Close on Bloomberg. As we mentioned, Gap just released its latest results, and what we can tell you is the stock is moving higher in after-hours trading after it said net sales came in at $3.8 billion, higher than what analysts had anticipated. And in part, that's because Old Navy comparable sales unexpectedly rose for the quarter. Analysts were looking for a drop of 8.5%. But again, Old Navy's sales did unexpectedly increase. So for more, let's bring in Zachary Waring. He is equity analyst over at CFRA Research. Zach, so good to speak with you. This is the first full quarter of results, financial results under Richard Dickson, the new CEO previously of Mattel. How much of this earnings beat can we give credit to Richard Dickson?
Yeah, thanks for having me. So probably very little of this quarter you can credit to him, probably a little bit, but it was a strong quarter overall. We like that, Old Navy performed well. The other three brands obviously had pretty much a significant slowdown. Gap down 15%, Banana Republic down 11%, and Athleta down 18%, which is surprising on the Athleta front. That was once their growth brand had grown for 25 consecutive quarters. So it's an interesting quarter for sure.
It's an interesting quarter, and you could see that perhaps expectations weren't too high with the stock up 11% right now. You mentioned Old Navy and the strength there, but when we talk about strength, it's all relative. We're talking about a 1% comparable sales increase versus consensus estimates of a drop of 8.5%. Is that the growth engine in Gap's portfolio, a brand that posted 1% sales increase in the quarter?
No, it's actually not. Athleta is a much smaller brand that they have that they were very excited about a couple of years ago, actually really for the last 2 or 3 years. And we expect that growth to reaccelerate. But Old Navy's been pretty saturated in the U.S. market, along with Gap and Banana Republic. So their growth brand moving forward is definitely Athleta.
Let's talk about Banana Republic, though, because there's been some interesting strategy moves when it comes to Banana Republic. Of course, working on the launch of a luxury furniture line. I mean, you think of Banana Republic, I think about, business casual sort of clothes. Does it make sense to roll out a furniture line as well?
It's a very interesting strategy. I don't think it makes sense. Banana Republic is an older brand. They had momentum this year. Obviously, this quarter was down 11%. But I definitely don't think that, moving into furniture is a good move for the company. The lifestyle brand, that they're looking to, make it a little bit more luxury, which I think is a good move, but I don't think the furniture move is the right move.
Yeah, I'm interested to see what the couches look like. But in any case, when you think about the portfolio overall, I mean, at Old Navy, you saw actually comp sales actually rise. But then you take a look at Banana Republic, you take a look at Athleta, you saw same-store sales decline at both of those brands. But when you think about what we've heard from retailers overall, it feels like almost everyone is missing when it comes to same-store sales. Does that environment that they're reporting this weakness into sort of soften the blow there?
Yeah, I mean, I think expectations for retail this quarter were very low. A lot of companies seeing, pretty significant slowdown in top line. So, you're seeing across the board around 5 to 10% for most of these companies, which is the case for Gap as well. We'd like to see their three, larger brands, Old Navy, Gap, and Banana Republic, see sales stabilize. Obviously, Old Navy has, but we would like to see Athleta turn around, turn a corner here with sales down 18% compared to last year. That's not what you want to see for your growth brand.
No, absolutely not. So going forward, so much of it is going to depend on how Richard Dixon really puts into place his own strategy at Gap. As I mentioned, he's previously with Mattel. You talked about how we can't really give much of this past quarter's performance, give him any credit for that. What are you looking from him to really execute on as he takes the company under his wings?
Yeah, he had a strong track record at Mattel, and we think that'll convey. It might take some time, but I think he's on the right path. So he's focused on gross margins and not so much, sales growth, and which they've benefited over the last few quarters. Their shares have popped off their low for the year. So yeah, I mean, we think he's moving in the right direction, and we think his track record speaks for itself. So maybe some promise on the horizon.
All right, you take a look at Gap shares after hour right now, currently up nearly 11%. Zachary, it's great to get your instant insight there. That is Zachary Waring of CFRA Research. Now coming up on the close, thousands of unionized Starbucks baristas walking off the job today as negotiations between both sides stall. We'll get the perspective next. This is Bloomberg.
I'm Scarlet Fu. Let's take a look at how markets performed on this Thursday. You had some data that showed disinflation seems to be the trend here in the economy, and the bond market liked it. The stock market didn't react much in any direction. You could see the S&P 500 moving up marginally, but it is extending the rally that we've seen since late October. The 10-year yield comes down to 4.44%. The dollar little changed on the day. It sets us up for this continued gain in equities as we head into the year end, however small it might be today.
All right, well, let's get to one of the biggest stories today, and that is thousands of Starbucks baristas on strike today for a one-day work stoppage, claiming that the coffee chain is refusing to fairly negotiate with their union. Today's strike is taking place in more than 200 cities across the country. Then the union says it's the largest one to date. Joining us now for more is Josh Edelson. He is Bloomberg News senior reporter covering the U.S. workforce. And Josh, as I understand it, the stoppage that we're seeing today is a repeat of last year. It's Red Cup Day. Last year, it was 113 cafes. What's changed between what happened last year and what leads us to today?
That's right. In Philadelphia, I talked to a barista today who said she doesn't expect to work any Red Cup Day until there's a union contract with Starbucks, however long that may take. What's changed is that the union says this is the biggest work stoppage they've done. Thousands of workers in hundreds of cities participating, the union says. But what we're seeing is a series of efforts by the union to force some change in the company's behavior, because at this point, it's been almost 2 years since that landmark first win in Buffalo, New York, where workers unionized, and there has not been significant progress towards winning a union contract at any of the now over 350 cafes that have unionized around the country.
Yeah, that's a good point. It's been 2 years. So, Josh, what can you tell us about what the efforts have yielded? What has been accomplished? If there hasn't been that much progress, something has been done since then, no?
The spread of the union has been stunning. This is one of several brand name major U.S. companies that were previously union free, where now workers have voted to unionize, have unions that are recognized by the government. And in each of these cases, we've seen a struggle to actually get a collective bargaining agreement. So the union has mounted advocacy campaigns, has tried to take on various issues in the workplace. The union argues that the company has made changes in response to that activism, but we have not seen at Starbucks or similarly at Apple or Amazon or Chipotle an actual collective bargaining agreement reached. At Starbucks, the U.S. National Labor Relations Board has accused the company of refusing to negotiate in good faith, but the process for litigating and appealing those cases can drag on for years, and the U.S. Labor Board doesn't have the power to fine a company punitive damages or hold executives liable. And so we've seen the union turn to a range of tactics, including outreach to students on campuses where Starbucks has contracts, outreach to politicians, trying to force the company to change.
Fantastic setup there. Josh, really appreciate your giving us some context there. Josh Edelson joining us here for the basics on what's going on at Starbucks today. Let's continue this conversation now with Michelle Eisen. She is a Starbucks barista and an organizing member for Starbucks Workers United. Michelle, great to speak with you. I want to talk first about the walkout today and how it's taking place on Red Cup Day. And this is significant because it's one of a number of promotions that Starbucks, the company, has run, including half off Thursdays, buy one, get one free offers. What is it about these promotions that the parent company keeps running that is troublesome, difficult, and challenging for the staff?
I mean, they're troublesome because the company simply does not staff the store adequately for the uptick in business. In fact, these Thursdays that were thrown at us in the month of, I think it was September, they came out of nowhere. And managers were actually instructed by the corporation not to up labor to compensate for this uptick in business. And that makes for a terrible situation and environment, not only for the barista working those shifts, but also for the customer who's coming in expecting to get their beverage in a timely manner.
Yeah, it's a good point. It's hard to explain to someone who really needs their caffeine fix what's going on when there aren't enough people to answer any questions. We've been talking about Starbucks union campaigns since 2021. It's been 2 long years. And we know that unions growth has slowed down a little bit since earlier last year. Is the campaign having trouble keeping up momentum? And if so, why?
I don't believe that the campaign is having trouble keeping up momentum. I do think, and I think this has been very apparent, Josh just gave a very sort of in-depth report on the legal issues that we've been facing with the company. The company continues to break U.S. labor law. And some of those labor laws involve surveillance and intimidation of workers who are wanting to organize. So that is something that we have to continually overcome. But I think what we need to take notice of is that in spite of this very public war on their workers are still contacting the union daily, especially around these specific situations like Red Cup Day, where they know they're going to go into an awful situation, asking us with help to organize their store. Workers are not afraid of this company, and the company should be very afraid of that.
Michelle, I'm glad you brought that up because the U.S. Labor Board, it's issued over 100 complaints that accuse Starbucks of illegal anti-union tactics. When you think about that, has that, in your view, changed at all how the company is behaving and operating?
Oh, absolutely. I mean, I started with this company in 2010, so I've got a wide breadth of knowledge, institutional knowledge of how this company was functioning prior to this campaign. They have changed how they do just about everything, from hiring to training to surveillance within the store, actually installing different types of surveillance, which, they say is for our safety, but the reality is they're using it to surveil their own workers. And so we should take note of that. It's very serious when a corporation that has essentially endless resources like Starbucks decides to turn those resources in on their workers to attempt to stop them from executing their legal right within this country to organize their workplace.
Michelle, what do you think it's actually going to take to get an actual union contract, though, with Starbucks? And what potential timeline could we be talking about here?
I mean, what we are seeing right now, this very vocal, very public display of solidarity between not only the Starbucks workers, but our labor allies who are standing with us, that's what it's going to take. It's going to take the public saying, hey, this is not acceptable. You cannot treat your workers like that. It's going to take labor allies saying, hey, look, we're standing with these workers. So, you've got about 9,000 unionized Starbucks workers right now to date. Add on to that thousands of additional labor allies who are willing to say this company is not what it's cracked up to be. You're a progressive company, Starbucks. Let's see that. Embrace the union, set the example for the service industry, be on the right side of history, and we're going to keep making sure that this campaign stays in the public eye.
Michelle, you have been a 13-year Starbucks barista in Buffalo, New York. So you've been working at Starbucks for more than a decade now. What surprised you about how the parent company has responded to everything you've done, to your union campaign?
Truthfully, I'm surprised every single day that we're still fighting the way we're fighting. When this was presented to me as an option in 2021, I was at a point where I was very frustrated with the company and how they had been treating their workers, in light of this global pandemic. And I thought, okay, here's an opportunity to present them with an additional option, to let them know that we as workers are here to solve some problems and we can have a seat at the table. We can have really great conversations. Nobody knows how to run these cafes better than those of us who are in there every single day. And I thought, hey, they'll probably resist this initially, but they're going to eventually see the light and realize that this is the right choice. And the fact that we're 2 years in and they still are fighting this the way they are, it's really, really disappointing. I'm not even sure that's a strong enough word, but I came to this company because I thought they were better and I expected them to react better to this, and they just have not.
Well, Michelle, we really appreciate your time. Great conversation. That is Michelle Eisen. She is a Starbucks barista and an organizing member for Starbucks Worker United. Meanwhile, the Starbucks union is less powerful than the lattes. At least that's the argument from Bloomberg opinion columnist Beth Cowett. In her latest column, she writes, quote, while the action may be the union's biggest strike ever, it's unlikely to affect Starbucks business in any meaningful way. And I'm thrilled to say that Beth joins us now. Beth, unpack that argument a little bit for us and why maybe what we're seeing today won't actually meaningfully impact Starbucks overall.
Yeah, well, I think the big point here is it's not necessarily going to impact sales, right? We might see a hit to the company's reputation, but we know historically when it comes to boycotts, which, I think in this case, the union is trying to get customers to not shop at Starbucks today. It's really, really hard to change consumers' behavior. And we just know that it doesn't usually really move the needle that much on the sales front, at least.
Well, how does that compare to what we've seen at Target, at Bud Light, where it feels like we've seen strikes that actually did have somewhat of an impact? Why is Starbucks different here?
Yeah, so those examples are great ones, and they sort of prove the rule in a way. So we know in those cases that that was a real issue that really sort of riled up the right, the conservative base. We know that anti-transgender issues are really important to conservatives, and that is something that they're willing to close their pocketbook for. I think in this case, it's just a little tougher, I think, to get consumers riled up about staffing issues, about scheduling. So I think that's one big piece of it. I think another is that Starbucks is just a really sticky business. People want their coffee every day. They have a routine. It's a pattern. Hard to get people to break that, even if they do agree with the messaging of the union.
Yeah, they probably can't think straight until after they've had their coffee in the morning. Beth, I wonder, and we heard from Michelle about this too, that she felt disappointed given what the Starbucks brand meant to her when she first started working there. And I think that's in reference to how Starbucks was kind of held up as this model of corporate progressivism. It's been willing to kind of stand out, speak out on issues like Black Lives Matter, on same-sex marriage. Does it have a reputation to lose perhaps by not playing nice with the unions?
So this is a point I actually brought up in my piece. There's been some research that's shown that companies that already have that have sort of the best reputation are the ones that actually are impacted the most by boycotts because they have the furthest to fall. I mean, I would argue here that Starbucks has already lost some of that clout with the left, right? As you said, they were viewed as this very progressive company standing up on issues before that was really the trendy thing to do. And I think that its liberal customer base has been disappointed by, its alleged anti-union tactics here. So I would say in that way, maybe reputation already tarnished and doesn't have as far to fall here.
The other thing to keep in mind, too, when you reference this, is how sticky Starbucks' consumer base is. And part of that is because of the loyalty it's built up through its rewards program. That's just a built-in customer base that isn't going anywhere because they're invested in spending money there daily.
Yeah, I mean, in the case, I'll go back to Bud Light here for a second. I think that is a product, sorry, Bud Light fans, that is easy to substitute, right? You can just grab another beer. It's a mainstream product. Starbucks is mainstream, but I would say it's more ubiquitous than it is, that consumers are able to substitute. It's so ingrained in their lives. 60% of the customers' sales come from members of its rewards program here in the U.S. So I just think that it is just hard to get people to break their patterns. And even if they say they agree, it's a tough one.
All right, Beth, got to leave it there. Really appreciate your time. That is Beth Coet of Bloomberg Opinion. Now coming up, more on labor economics with Heidi Schierholz. She is former chief economist at the U.S. Department of Labor. That's next. This is Bloomberg. Well, as we've been talking about this afternoon, thousands of Starbucks baristas went on strike today, and it's really the latest in a growing number of similar actions that we've seen across the country in recent months. And joining us now for insight on the labor market is Heidi Schierholz. She is president of the Economic Policy Institute and former chief economist at the U.S. Department of Labor in the Obama administration. Heidi, it's great to have you with us. And I don't need to tell you that it has been just remarkable watching these strikes, these union actions roll across the economy, across industries. When you think about that, how it feels like it's affecting pretty much every industry, is there a common denominator beneath all of those?
That's a good question. It really is hitting. It's auto workers, actors, baristas, hotel workers. You're seeing thousands, tens of thousands of, maybe even hundreds of thousands at this point, workers across the country, either striking or in some cases threatening to strike, which has led to better contracts for them. Like you could think of the UPS strike, or the UPS threatened to strike earlier this summer, didn't strike, but got much, it was an important step in them getting good contracts out of that. So it really is hitting all corners of our economy right now.
All corners of our economy. And with that in mind, given how widespread these strikes are, do you expect to see that to roll up into the official data that we get every month, in some cases every week. When does this go from idiosyncratic into something that we see actually in the official numbers?
That is a fine question. We are definitely seeing the outcome of most of these actions have been big wage increases and wage increases in contracts that are much larger than what those same contracts had been in prior years. So there's definitely big increases coming out. And we are also seeing that not just workers who are in the unions getting increases, but we're seeing this union spillover effect sort of play out in real time. And the spillover effect of a union, that's when, say, I'm a non-union employer, but unions are strong in my industries and unionized workers get wage increases, and I have to then increase wages for my workers to get and keep the workers that I need, or in some cases, I might do that to keep my workers from unionizing and my shop. Mm-hmm. We are seeing that also happen. Like Toyota, Honda, Hyundai, none of their workers struck. Their workers are not unionized. But in response to what happened in the big three, Auto and GM, in Stellantis, and in Ford, those other Toyota, Honda, Hyundai got big wage increases. So you can see this spillover effect happening. It's not, I think, even though this is hitting thousands, tens of thousands of workers, it's a good question. I think it's still at this point not big enough that we're seeing it in the larger numbers. And that comes down to the fact that even though we're seeing a lot of union activity, the share of workers who are in unions right now still is quite small. And that has everything to do with the state of our labor law, which really does not facilitate workers' true right to join a union. That's a whole long other conversation. But I think the fact that it's still a relatively small share means we're not seeing it in the aggregate numbers now, but it is certain. We're certainly seeing big impacts in certain industries.
Yeah, we'll see it anecdotally for sure, and that's what we've been seeing during the earnings season. One thing that the unions have done very well that gets people's attention, of course, is when they're pressing for higher pay, is they're citing CEO pay increases, specifically percentage numbers in terms of how much CEO pay for the big automakers have increased since 2008, for instance, and comparing it to worker pay. And it's something that really points out the contrast between the two, upper management and the workforce. Do you see a scenario in which CEO pay starts to slow down as the companies realize the optics of this just doesn't match up?
That is not how things have been going. We've been seeing CEO pay rise dramatically for several decades. So in order to will this halt and reverse those trends? The CEOs now make on average 344 times typical workers in their company. So not just 344 times the lowest paid worker in their company, but basically like 344 times the median worker in their company. It is outrageous. That has grown to just astronomical levels. We also have seen in union actions now, union organizers not just pointing to executive pay, but also to corporate profits, which have really exploded in the last couple of years. So they're really highlighting some sort of structural problems in our economy. I think we're going to need more policy change to have those trends really halt and reverse.
Heidi, very quickly, it's not just pay increases as well. The unions are pushing for improvements in health and safety practices, increased staffing overall, more paid time off. Are those concessions that companies may be more willing to make than to increase pay?
We're seeing it happen in both. It is absolutely true that when unions make demands, it's almost never just about wages. It also includes other things that are idiosyncratic for their workplace. Like UPS, when they were threatening to strike last summer, one big thing was we need our trucks to be air conditioned. That's the kind of things that unions are winning right now. Paid time off, like you said, those things often go hand in hand with pay increases.
All right, Heidi, it's really great to get your perspective today. Really enjoyed this conversation. Our thanks to Heidi Schierholz. She is president of the Economic Policy Institute and former chief economist of the U.S. Department of Labor. Now, still ahead, what investors need to watch for tomorrow? That coming up next. This is Bloomberg.
All right, let's look ahead to tomorrow, the end of the week, and on Friday, let's start off in Europe.
We have ECB President Christine Lagarde. She's going to speak at the 33rd Frankfurt European Banking Congress. That should be pretty interesting. You'll have to wake up early, though, in New York.
And of course, she's got one message to hammer home, and it's about inflation, waiting for inflation to come down, doing what they can to address inflation. And of course, it comes on ahead of Euro inflation, which will be out at 5 a.m. New York time.
And then we bring it to the U.S. day, 8:30 a.m. New York time. We're going to get U.S. housing starts. We know the housing market has been interesting, to say the least, so that'll be fun as well. And then we get a lot of Fed speak.
A lot of Fed speak. Collins, Barr, Daly, Goolsbee. I mean, I think the message will be pretty consistent.
I think so. A pretty top-down message
2%.
There.
2%.
We do have BJ's earnings after the bell, before the bell, rather, as well. And also Buckle. I don't quite know what that is, but
our cameraman says that there is a retailer in South Carolina named Buckle, or in the South. So I think that does it.
That is good to know.
We're from the Northeast, so we're not aware of this. But that does it for us. Balance of Power is up next. Have a great evening.
Yeah, this is Bloomberg.